the possibilities for people to be rewarded by participating in making decisions, by being rewarded for participating in voting, making proposals, contributing to the discussions. And building those sort of systems early on, it starts to add value from the very beginning, both to the people participating and to the network. So I see that sort of approach can really benefit almost any sort of project. Then the challenge is how to build the right mechanisms, the governance mechanisms, so you can still make decisions, so you don't end up paralyzed, or you don't end up going too divergent, like's happened to some projects that try to build a community, but then didn't build the governance systems for the community. They kept a very centralized governance, and then slowly start to be some rupture in between, let's say, the governance, the core, the governance committee, or whatever way they're calling it, and the rest of the community that's going in a different direction. So actually having those decentralized governance mechanisms early on is very, very helpful to prevent that risk, and to truly give a voice to your contributors at large, who sometimes have surprisingly valuable ideas.
Yeah. So talking about, like how the, future business or the future organization is gonna adopt the DAO. I think the number one important question to be answered is like, people firstly need to decide what need to be governed at the first place, and then they could, balance this efficiency and the fairness problem, like that by design, like a different type of DAO or different type of technology will have different edge, weigh on either effectiveness or weigh on fairness. So I just feel like even though like DAO is still like early stage, and many of these DeFi and the crypto projects don't really it's just about bootstrapping and also getting started. So just at different stage of the projects or different stage of the involvement of a certain organization, they may want to use a different approach of how to use DAO, because DAO at the end is gonna be like, it's part of the tool. It's not like a goal. So I feel like there's still gonna be a lot to explore, and how people combine this on-chain DAO technology and also balance different angles. So yeah, that's my opinion on this stuff.
Awesome. Yeah, agreed. And so for both of you, in your opinion, what are some of the best governance models out there that you guys have seen?
So from my side, generally, I see that most protocols, most projects end up going one or two directions. Either they go with a more representative democracy, and they're electing a small council. At that point, quite often what they end up doing is using a multi-sig, or, for example, the Aragon membership template that allows you to do a similar functionality and so on. But essentially what these projects are doing is having a small group of representatives that govern the community. And then on the other side, you have projects that go kind of the opposite direction, and they go more towards direct democracy. And either that can be done fully on chain with like the tool that we develop ourselves, like Aragon V1 enables you to do that. And it can be done in a way that is more manual, like using, for example, Aragon Voice or Snapshot, which are more or less equivalent tools, and then having a human or someone that actually executes the transaction on chain. Obviously, that has risks, because if something happens to that person, then suddenly your whole governance breaks down. But at least you're trying to empower anyone in the community to make decisions and to vote on those decisions. And actually, the projects that I like the most, they they end up taking more a combination of both things. I'm a big believer in something that's called polycentric governance. That is the idea that no single decision-making system is good. What we need the most is multiple decision-making bodies with a little bit of overlap that together can govern a community. And so, for example, for the Aragon DAO experiment that we're going to be running over the next few months, what we're going to be doing is actually combining both things. Is both having a main DAO that works with a somewhat direct democracy model. Anyone can make a proposal, the community can vote directly on them, and then at the same time having an executive DAO who are elected to manage funds, but they don't have the power to change the governance system. And so that way we avoid a little bit the challenge that sometimes can happen, in that those elected for the governance end up living a little bit in their own bubble, having a very different reality than the community as a whole. And if they have the power to change the governance system, well, there is nothing stopping them from changing the rules to benefit them, even if this happens very slowly and very gradually over a few years, or like they might not even be doing it consciously, but it can happen. So however, if we have both mechanisms, and as well we're using Aragon Court as a sort of judicial system, so if anyone is trying to put forward a proposal, whether they're part of the executive DAO or the main DAO, a proposal that goes against the agreements of the community, then anyone in the community can challenge that and get it stopped, and the person who put forward the illegal proposal, so to speak, loses their collateral. So that creates a bit of a division of powers, in that we have not exactly the same, but we end up having a bit of a judicial system, an executive system, and then a legislative system that is the DAO as a whole that decides how to govern itself.
Got it. Looks like we had a question that popped up and it just kind of disappeared for a second, but if it pops
it was
back,
I read it. It was how would you recommend Web3 communities start converting into a DAO using Aragon?
So for me, the solution would be, and thank you Joshua for reading that, would be to just launch the DAO and transfer a small amount of funds to that DAO. Give your community, give your token holders or your members, because you can also have one person, one vote, and identify them through an NFT or an ERC20 token or whatever you want. But just give your people the possibility to vote, but you only transfer a small amount of funds. So your only risk is that level of funds. You can even start with a very tiny amount. You can start with, even if your project has multiple millions of dollars, you could transfer just $5,000 there and have the community vote on how that's used. And by actually kind of like jumping into the pool and doing the governance, doing that decentralized governance usage, you will learn a lot faster about what's working, what's not working. And then the other thing parallel to that, really do a lot to build community, to build relationships, to create platforms where people can talk and so on, and try to create more focus and engagements on the purpose of what you're trying to do, rather than on just quick financial gains. If you just give a lot of quick financial incentives, the relationship that the people are going to have with the project is going to become very transactional. And so the moment that they're not receiving a lot of rewards for participating, they're going to be like, why do I care? So try to find alternative ways to incentivize people than just rewards. Make it more about what you can build together. And of course, there can be financial rewards to benefit that. But building a real community in that real sense that people feel like, oh, this is a great group of people. I feel like I belong here. I feel comfortable and so on, will really help to get your small experiment going faster.
Got it. And we have another question that has popped up. Asked from somebody in the audience. So on the legal side, would the granting of voting rights to the governance token holders make them more like securities than utility?
I think it's the opposite. I think it becomes more of a utility, actually.
Yeah, I would agree with what Joshua is saying. It's if the definition of a security, and I'm not a lawyer, so please seek proper legal advice if you need. But in general, a security means that you're more a passive investor. You're not doing the work. If you're a worker in the project, that tends to move it a little bit more towards a utility. So participating in governance, making decisions, that makes you a little bit more of a worker. You're contributing your own intelligence, your own ability to process information and so on, and decide how the project should operate. So that should help it be more of a utility.
Awesome. Thanks. Okay. So, in your opinion, everybody who's on this panel, like in terms of really, the governance models becoming more ubiquitous, and, in terms of the challenges, what are some of the challenges that overall we really need to overcome?
I can't seem to hear from Alex. Could you guys hear?
Yeah, I can hear.
Oh, okay. Yeah. I guess I have some network
He was
issue.
asking what some of the challenges are of the governance models.
That we need to overcome to make governance models more ubiquitous.
Yeah. Could you guys hear me right now?
I can hear you. Yeah.
Oh, okay. So yeah, I think I will just go ahead. So yeah, I think really, the challenges here is about how to encourage more people to participate, because in general, many of these projects, like the superstar projects, like Uniswap, like Compound, even like a Sushi, they have a lot of they have set up a proper DAO, and they have the technology. But the problem is kind of still very few people could be able to participate into the discussion, let alone to make any rational decisions. I think that's a first layer of barrier. That is how to communicate information to a broader audience, so that they understand how the DAO works and how. I mean, many of them, for example, maybe the uni-tokers, they don't even know that they have the they have the right to vote for some stuff. So that's the issue.
I definitely want to add to that. I think voter apathy is probably. Sorry, I'm super blurry. I don't know why. You're just gonna have to pretend you haven't got your glasses on. But the thing is that voter apathy is a real big problem across the board. So what we're doing with the standard is trying to look at governance models more. I got into Bitcoin because it was more an anarchic philosophy of how can we have stuff without government and without governance, but with rules, of course. And so one of the big steps forward in governance through a different mechanism than voting, because voting really, everyone's seen some of the talent shows and some of the crap that bubbles up to the top because people are voting through empathy, through empathy of a bad story, or someone's dad died, so that singer then goes on top even though he's not the best singer or whatever. Oh, there we go. I'm sharper. Wow. So voting is really inefficient, and so we're looking at it from a different perspective of using prediction markets to determine the future. And prediction markets are, there's a lot of academic work to really highlight the fact that prediction markets are the best way humans have of predicting the future. And so if you can not say something like, just, vote Biden or vote Trump, for instance, instead you say, who will make the GDP? Will the GDP be bigger under Biden in 3 years than Trump? And people will wager bets. And the thing with betting, for the lack of a better word, is that people tend to put away their dogmas on what they might think is the right thing. So they might really be a Trump supporter, but they might think, the GDP might be better with Biden, or the other way around. And so betting tends to then reward the people that were correct. So if you've got information about a certain subject that you don't think the other people have in the industry, then they will bet on a better outcome that might be the actual truth come the date. And so I think with voting, we can do things in DAOs to promote voting. The reason why I think this will stop voter apathy, well, not stop it, but help reduce voter apathy, is that there's an incentive to vote. There's an incentive that you could win money on being the right predictor, so I feel like there's more to be explored than just voting. I find that voting is very sort of it's very primitive. It's the first thing that comes to mind, like, oh, let's have a vote on that, when really no one is an expert in any of it that's giving the vote. So it's like, and then if you incentivize people to vote, if you're like, oh, we'll pay you to vote, then you're just going to get people that go, oh, wow, cool, force it, just click anything and you get paid. So, so really, I feel that this needs to be explored more. And I know that, of course, people like, there's a great talk from Ralph Merkel about prediction markets and voting, or prediction markets and governance, on Epicenter Bitcoin. That was a little while ago. It's definitely well worth listening to. I really feel that there's something there, and DAOs need to move towards that model. Even if people use the prediction markets as a pointer to vote with at the start, to stop any sort of game theoretical challenges that come with using the prediction markets to manipulate an outcome. So yeah, that's my take on apathy.
That's kind of building on that, and I love that the discussion is going to prediction markets, because I find them a fascinating tool, but can very much be a double-edged sword in that used in the right cases, they're really powerful. They encourage people to participate. They really help to aggregate a whole bunch of insights that you would never find out about otherwise, to get a really good signal on where things are going or what the best decision can be. But equally, they only work when you can have a lot of, like, a very simple way to measure whether an outcome is good or bad. Like the example you were giving of, like, will Trump or Biden increase GDP more? And he's like, we can probably run a prediction market on that, but is GDP the right metric? Or should we have something that is more well-being related, and should it be GDP in 3 years or GDP in 10 years, right? And that's where it starts to become a little bit complex sometimes. So we need to be careful on how they use them, although they can be, as I was saying, a really fantastic tool. And I think also to highlight something that Joshua, you're saying as well, that is moving past voting, that sometimes voting is not necessarily the best idea. We've been toying at Aragon a little bit with the concept of lazy consensus, that is and what we call optimistic governance. That is the idea that using an Aragon governed DAO, now we build that technology, but essentially anyone can program an action in the blockchain, and unless it gets disputed, unless it gets challenged, it happens. And if you use these kind of like small scales, making small decisions that aggregate, you can end up with something that is, well, that in a way resembles more traditional governance in an organization. Like, in a way, you can go and probably use your credit card and spend a small amount. And if you do things that really go against the organization, you're going to get kicked out. In the same way that with Aragon Govern, if you do something that's really wrong, then people can challenge you using Aragon Court, and you're going to lose your collateral. But for small things, it works a little bit like an ant colony or like a termite colony, in that you have this thing called stigmatic governance, in that small people making small decisions give a signal to everyone else of, like, hey, there might be some food here. So the next person goes, oh yeah, that looks cool. Let me put a little bit more resources to that. And it kind of evolves a bit organically. So you have these different things. But another quick point I wanted to touch on is that someone said that most users are not so intelligent or willing to learn in the chat. And And I actually wanted to argue back against that, because quite often we think that that's one of the biggest excuses for centralization is like, let's just give it to the experts, or let's give it to a committee that we elect because they know best. And expertise have a role, but there's been really interesting experiments in collective intelligence where it's actually citizen assemblies. This was done recently in France, where it's a group of people of non-experts who are put in a position to make decisions and to make suggestions for example, climate change. And the important thing is that they should have access to experts, but if the experts control the process, the experts are very rooted on what has been, what they have already learned, like their expertise ends up making them a little bit square, a little bit rigid. And so usually having a broad group of people to be able to participate can work really well. And in fact, that works in Switzerland really well, where they're running a lot of votes, and the country is run very well. People tend to be very happy with their governance. Now, the thing that this person had also mentioned is that technical terms scare people off, and I think that's also one of the biggest barriers to governance is the information flow. Is if you need to get your insights in a forum and then also join a chat, and there is a million different chat channels, and also on Twitter and a Medium post, and somehow go through all of these million different platforms and try to understand what's going on. And the language is super difficult, and you don't know the people, because when you're at the beginning of the project, you meet kind of like the new joiners, you meet them one by one, you build a lot of relationships, and you end up being kind of like at the center of the social network. If you're from the outside trying to join in, it takes so much time and energy. There are projects I love that I wanted to be part and contribute to, and I end up giving up. It was like I spent like 3 days trying to meet you guys, or 4 days. I'm not being paid for any of these. I still have no clue who I need to speak about anything or where to go. It's too expensive time-wise for me to learn how to even participate. So I think onboarding and doing better onboarding, welcoming people, saying, hey, here is great information, have very good documentation, very good knowledge sharing, can really, really help with voter apathy.
Yeah, just want to add one very quick point here that DAO also need better user experience, just like any other products, because all this social communication could become getting really messy. Like Daniel mentioned, like I was trying to figure out some projects as well myself, trying to get into different channels, but there are just so much noise out there. And most likely will end up, giving up on participating some of them because they don't have a good procedure. They don't have a good user experience on organizing this DAO. So I think that's, also could be like a good direction to work on down the road for building like a better user experience for the DAO product and technology.
Yeah, I totally agree. User experience, number one. I think Aragon's gone really a long way in that. I really like.
Yeah, agree. It's so simple. It's like a couple clicks that you could set up your first DAO. I think it's a great product.
Yeah, we're starting to work on that, but it's been definitely a challenge. We're coming from an industry that's been so geeky, and myself, I fall into that, go end up in a rabbit hole of what are the different Condorcet methods for voting and how do you tally all of these things, and then forget that there is people on the other side who are just trying to live their lives, and for whom governance is not the objective, but just a means to an end. So we're now trying to backtrack a little bit from that and say blockchain at the beginning was very much for developers, and now I think this next wave that is happening is this is blockchain for non-developers. This is blockchain for non-coders, where we need to make it like human readable, very simple interfaces where everyone can understand it in a graphic, intuitive sense. And we're starting to head in this direction, but it's definitely early days. And I think the industry as a whole is starting to make a bit of this shift, but we definitely have a lot of work to do there.
Yep. But I do feel like, sometimes when people build a UI or interface, they also don't want to, impact the people's idea. Because when you present some stuff on the front end, you are also implicitly, tagging them like this is gotta be the matrix that we need to focus on, and this is the stuff that need to be governed on. So there may be a little bit of concern out there, like how to make a fair UI system for the general users, so that you don't lose the diversity of thinking and just from the general users.
Yeah, I think a lot of it also goes down to minimizing what the users need to vote on and having everything predetermined already in the contracts, so that users know what they're getting into anyway beforehand, and the few things that are voted on aren't that complex, and we can bring it right back to being as simple as possible.
Awesome. Thanks everybody for each individual contributions. Fortunately, even though this panel started a little bit later, it looks like we're kind of running out of time here. But, I would like to thank you, Joshua, Daniel, and Bill for, contributing to this really, really interesting panel. And if anybody has any last comments before we wrap up, that would be great.
No, I would say take part in governance, get in there, start to learn how these protocols work. Don't just buy the token and sit there and hodl. Be part of the projects, and also contribute. Contribute. If you're a graphic designer, contribute. If you're a coder, contribute. If you're a speaker, contribute. If you're a writer, contribute. If you're a meme maker, contribute. This whole ecosystem is powered by memes, as we all know. So but it's all about contribution, and I think maybe it's a learning curve as well, that people move away from just the hodl moniker to the actually participate and use your passion to drive projects forward that you believe in.
I love that. I love the participate as a new moniker. That should be our new meme. And really, and really get started. If you have nowhere else to go, and perhaps erring a little bit too much on the side of self-promotion, but you're very welcome to join our Discord and have a chat there. We'll do our best to answer your questions about governance, support you with your own project, and really find projects, find protocols that you think are cool, get involved, learn about them, ask questions. If the people are saying, oh, you shouldn't ask that, that's a stupid question, that's not the place to go. Just leave that place, never go back, and find the places where you'll be welcome with open arms, because there is plenty, and there is a lot of room to contribute in this space. There is a lot to be built. So don't be afraid to ask naive questions. Don't be afraid to get started.
If I want to add one more point, that is, this entire Web3 thing is about co-creation. And with a DAO, you could really be part of it and get rewarded.
Awesome. Well, again, thanks everybody for contributing to this panel and contributing from different parts of the world. So appreciate it. And I think we're going to kind of segue into the next panel. I think everybody has to go backstage.
All right. Thank you very much.
Thanks for
Thank
having
you.
Guys.
Great discussion. Bye.
Need large server farms and resources to run a Mint Layer node. Just your personal computer. Mint Layer. Opening Bitcoin to DeFi. For everyone.
Wow, what a video. So, welcome to the stage, Andreas Cole. Mint Layer, he's the Director of Institutional Relations at Mint Layer. Mint Layer is a Bitcoin sidechain bridging BTC and DeFi being developed in the Republic of San Marino. In some circles, Andreas is known as Mr. Liechtenstein because he has been a dedicated evangelist for the Principality, initially mainly promoting its unique constitutional freedoms, right of secession at the municipal level, within libertarian circles. In early 2015, he was awarded a prize by Liechtenstein's ruling prince for an essay he wrote about decentralization, a third of which was dedicated to monetary decentralization and blockchain technology. He took advantage of the opportunity to give the prince his first Bitcoin and get introduced to the head regulators of the country and give them their first crash course on crypto. Welcome, Andreas.
Thank you so much for having me, Lavinia. Let me just share our...
Hello, everyone. We have our keynote speaker, Mr. Sam Bankman-Fried. He is the CEO and founder of FTX. And today he is going to be talking, of course, about FTX. And it was founded, before finding Alameda and then FTX, Sam was a trader on Jane Street Capital's international ETF desk. He traded a variety of ETFs, futures, currencies, and equities and designed their automated OTC trading system. He graduated from MIT with a degree in physics. Over to you, Sam.
Thank you. And thanks everyone for having me. It's a pleasure to be here. So I'm gonna talk some about Serum and Solana, about DeFi in general, where it is, where it's been, where I think it's going. Y'all should also just feel free to ping with questions in the sidebar thing here. It's 60% chance I'll figure out how to read them, and if so, towards them over the course of this. Anyway, and again, thanks so much for having me. When you think about where DeFi is going, and there's obviously a lot of different parameters there, and part of the hope is that it becomes something that's really big, and that it becomes something that's a lot bigger than it is today. And there's some metrics by which it's big today. There's tens of billions of dollars of value flowing through the DeFi ecosystem, but there's only tens of thousands to hundreds of thousands of users, which is not nothing, but it's less than the number of users of even the larger centralized crypto exchanges today. And so this isn't a mass market phenomenon yet. This is mostly something which is internal to the crypto ecosystem. But it obviously plays a really big role in the narrative around crypto, and around what crypto could become. And so, what gets us, from here to there, so to speak. And I think that there's a number of things that need to happen. A big one of these is solving scaling, and this is not an easy thing to solve. The core of it is that right now, on Ethereum, you can get about 10 total transactions per second going through the network. And if you look at how many do you need for DeFi, well, I don't know. It depends on what DeFi is and becomes. But just to start off with, right? What if you want to put one giant company on a blockchain? Take your favorite, really, really big company, right? Something that 1 billion people might use. Whether you're looking at something from finance or social networks or something else, you're sort of going to see something kind of like 1 million transactions per second, right? If you look at tweets per second, Facebook likes per second, trades per second, those are the sort of numbers that be as few as 50,000 for some of the less intensive programs, maybe as much as 20 million for some of the more intensive programs. And you can sort of go through this process yourself, but I think that's about where it tends to end up for a gigantic company. And that gives you a hint as to how big blockchains would need to get in terms of capacity and throughput, in order to really start to touch what they could be in their potential. And it means you have to be talking kind of about millions of transactions per second, probably, just a lot. And it's not just that it's bigger than 10, which is sort of where we are today. It's bigger than 1,000. And I say 1,000 because that's where alts are. In fact, that's where a lot of fast, blockchains are. And I think what you run into actually is that a lot of scaling solutions for crypto just don't scale enough. they're enough to scale so that today's ecosystem could comfortably use cryptocurrencies, but they're not enough to scale such that tomorrow's could. At least not in the cases we're all looking forward to. So anyway, that's just, I think, a really, really important backdrop to think about when you think about scalability. Is anything that says 5,000 transactions per second, it's a big improvement, but it's actually not enough of one. And so what can you do? You can either have a single something, we call it layer 1, layer 2 blockchain, roll up, sidechain, whatever you want, has 1 million transactions a second. Or you can kind of patch together 100 of them, each of which have 10,000 transactions per second. And that's sort of what, things like sharding are like, where you take sort of like independent chains, each of which is a few thousand transactions a second, and then you sort of weave them together. And it's a really cool idea. The problem with it is, like, you can imagine what happens if you took Twitter and you sort of sharded it between like 100 different shards, right? Like Bob would tweet something, and to Jim say, "Hey Jim, do you see my tweet?" And Jim's like, "Nah, I didn't see your tweet." I was like, "Why not?" Well, Jim says, I'm on Twitter shard number 71. That's where my account is. I was like, "Oh yeah, sorry, no, I'm on 53. So guess you can't see my tweets." Like, that's what happens if you have sort of like, each shard representing like 1% of the universe, and maybe on like an hour-long time frame, you could have interactivity between them. But what we don't have is sort of real-time interactivity, and you sort of get variants of this in a lot of cases where, I think sharding can be super powerful, but you sort of need to at least be able to get, like, at the very least, you kind of want each program to not have to be split between shards, right? Like single programs should be on single shards, and ideally even like, ecosystems or like, sectors. And so again, I think you kind of want to get to like a million TPS per shard, sort of. And just very, very few blockchains are even trying to get there. I think there's a decent chance that a lot of this tech hasn't been built yet. And, I don't think that blockchain tech is a solved problem. I will say that, I've sort of been involved in the Serum and Solana ecosystems, and what is that? Well, Solana, it's a blockchain, and the thing that sets it apart is that it really is shooting for that much TPS, for, millions eventually. It's, probably the fastest today at 50,000. But what really makes it different isn't the speed today, but it's the roadmap that is like, really, really actively shooting for way more than that. And so many blockchains, they sort of like have their current speed or a roadmap to get to a few thousand, and that's sort of that. And much of a roadmap to get beyond that. I see someone asking, how about ETH2? As far as I understand, now of course ETH2, it could become anything, right? And so, and I don't want to try and box it in, but if you look at what ETH2 I think is currently understood to be, with sort of the current iterations of it, or drafts of it, you're generally looking at something which is like, 5,000 transactions per second per shard, and then a lot of shards. And so you could use scale to large total network throughput in some senses, but it's going to have trouble fitting any single large applications on it, and composability doesn't work very well, at least not sort of like real-time composability between shards. And so when you look at a sector that you want to have interacting products in, once again you sort of like have this issue where 5,000 TPS is not enough to have a sort of like interacting composable ecosystem long term. So I think that, like, the way that I think about this, and sort of to sort of like respond to some other things I see people sort of asking here is not to say that sharding is bad, because I do think that at some point, like, there are real advantages to it, but that you sort of first want to get as much as you can on one single, like, natively composable shard, like on one track that is just totally real time interacting. And then once you have that, then you might want to duplicate that, in parallel lines. with like slightly more awkward composability between them. But I don't think you want to sort of phone it in too quickly. Like I think you want to build out as much as you can on each thread before you start duplicating the threads, because you do lose a lot when you start duplicating. So that's sort of like my thought on this. I should mention, like, other people disagree with me on this, so take this with a grain of salt. This is just sort of my bullshit thoughts. I do think it's like really, really important for the ecosystem to be thinking about this, because this is what's gonna, really determine a lot of the future of DeFi. And, it's one of the hardest parts of it to get right. It's one of the parts that you need to put lots and lots of work and testing into to get right. And you can't just sort of like at the end be like, oh yeah, let's jack it up 100x. Like, no, it's going to take years of design. And so I do think that that's sort of a fundamental thing that you want to be thinking about now. And when you look at DApp design, the sort of like way that you're designing these is going to depend somewhat on the technology it's being built on. It's not that hard to translate, but it's not trivial. And so again, when you think about something like the EVM, which is the Ethereum virtual machine, it is the most common by far way to be building decentralized applications right now. It's also not built for mass scalability in a single shard. And that's why you don't generally see EVM compatibility being prioritized as much for something like Solana. It would be very useful in some senses, but anything that was built using it, the risk is that it ends up not being able to take advantage of the faster throughput of Solana because it's being built in a way that isn't sort of natively parallelizable. And that is maybe just to get to like what is sort of the big philosophical distinction between, say, ETH2 and Solana. ETH2 takes a bunch of basically totally independent shards and then sort of layers on top of ways for them to, on long timescales sort of interact with each other. Solana takes parallel transactions that are each block syncing up with each other. And you can think of it as doing sort of what like memory stores do, where you can have like 100 people simultaneously trying to submit transactions to the blockchain and just all go through. They all are syncing up with each other, layering on top of each other. And if two people are both trying to affect the same memory cell, then whoever got there first sort of block out other people for a second or two, until that sort of like propagates through. But if two people are sending, actions that don't overlap in terms of what memory cells they're supposed to be affecting, then they can basically happen in parallel, and it doesn't actually matter which sort of goes first or second. And that sort of is the way that Solana views parallelization. And again, I sort of bring it up because I think it's a super cool tech, but I don't want to say that it definitely will be Solana that things are built on in the future, because who knows, right? I think it's cool, but like maybe there's going to be new technology that's built, right? What matters in the end is that good tech is built, and is able to to really move the space forward. That's I think that's sort of the biggest thing that's going to determine what programs we even can build. And a big part of this is we should be holding ourselves to a really fucking high standard with DeFi programs. And I think this is the other thing that I tend to have like a somewhat different take on than I think a lot of people in DeFi. I think that DeFi is extremely high upside and could be really cool and really powerful and has really new advantages. I also think that in order for it to be able to access those advantages, it's going to have to be a really great user experience. People are going to have to love using DeFi applications. And if they don't, you're not going to get that many people switching over from non-decentralized to decentralized applications. They have to be able to win on their own merits, not relying on the fact that they're decentralized, in order for the masses to be willing to use them. Now, if you can get there, I think people will be excited about the decentralization for them. But I think step one is you can't turn them off with the user experience. And right now, I think most DeFi products do, just because it's a new field. It's hard to build in DeFi. You're doing it right behind your back, because if you screw anything up, you sort of like barely, you maybe can't even patch it, right? It's like immutable code on the blockchain sometimes, and so it's not easy. You know, the entire sector hasn't been around that long, and it's competing with like very well built applications. And a lot of these teams aren't that structured, which is part of the nature of it. But I do think that building really, really awesome products is an important piece of this. And I don't just mean awesome theories. I mean like enormous thought going into the GUIs. I mean thinking hard about where each button is placed, right? Like I don't know, at FTX, like we get customers like yelling at us constantly if we put a button on the wrong part of a page, so it's annoying and there's too much mouse scrolling involved in clicking it. That's a sort of level that this is true of like most, large centralized exchanges. And people building DeFi GUIs have to think the same way. They have to think of themselves as really being held to building an unbelievably, well-tuned experience. Responding to some other things people brought up, what are sort of like, are there trade-offs here? Is it just like one's better than the other? Or like how would different chains, like are there costs lying? Yeah. So first of all, and sort of like lines up with some other people have said, it's not built on the Ethereum virtual machine. It's not built on Solidity. And, that means that current blockchain developers need to adapt to a new environment. And it means you can't copy paste apps over from Ethereum. That's a barrier to entry. The other thing, though, is you're just stressing the system more. If you're trying to build something that is very high throughput, that puts stress on everything. And that's true if it's decentralized or not, right? Like FTX, when we built FTX, there's a lot of stress on a lot of pieces of that system. And it takes a lot of work to have that never fall over, right? When things get busy, people are trying to send hundreds of thousands of orders per second on FTX. And we need to have 100% uptime. It's just like I'll sort of give one anecdote, which I think I've probably given before in some places. But we once had a couple minutes of effective downtime on FTX because of the following reason. It's like Chinese New Year, and as part of that, we uploaded some banner to the website. I did a picture on it, had some text. Turned out it was a very high resolution picture of a dragon, like very high resolution, and we weren't very careful about putting that very, very sharp dragon sufficiently behind various firewalls. And immediately someone caught this and started just requesting to download this dragon image like hundreds of times, thousands of times a second, and took down the FTX GUI from it. And that's sort of like one of many pieces of the system. That's a pretty extreme example, but it's just like everything gets stressed in ways you don't even realize it will when you try and scale something. And so when you sort of look at like at what happened with building a really highly scaling blockchain, well, all of the nodes have to do a lot more. You're just processing way more messages, right? You need to have like a more robust node infrastructure. It needs to be running on more powerful machines. They're not incredibly expensive. They cost hundreds of dollars, though. You can't. You sort of like have to be running like pretty well-tuned software to do it. You don't have massive margins for error in it. If all of a sudden there are massive spikes in volume from the high baseline to an even higher level, you have to worry about whether the nodes will even be able to keep up with that and produce blocks in time. And then you look at all the other infrastructure. How about RPC servers? Like, servers whose entire job are basically to serve APIs to dApps to be able to keep up with all the requests and all the data. And they need to be able to store all the data. As you see, like all these things that stress the system. And it's doable, but it's harder to keep up with. And so I do think that's sort of like, something to keep in mind whenever you try and scale DeFi, is that like everything gets harder in ways you forget. And I think that's an important thing. One thing which I actually want to touch briefly on, I think is probably top of mind for some people, is there's been a lot of talk about the infrastructure bill. This is a proposed bill in the United States around taxation of crypto. And there's been some thought that it might touch on DeFi some. And as what's going on there basically, interesting and complicated area of law in the States, but also globally, which is there are lots of businesses that have various legal obligations. One example is that some businesses have an obligation to report their transactions to the IRS for tax purposes, so that the IRS, knows who owes tax on them. Think what you will about that. That's sort of how the world is in general. And now you take an autonomous smart contract on a blockchain, right? And you're like, go, Mr. Smart Contract, please file the 1099s. Smart contract says nothing because it's a smart contract, not a person, and it can't understand English. And it sort of creates this really interesting tension. That's sort of underlying a lot of the regulatory questions around DeFi. And it starts to ask these complicated questions about who does have regulatory duties in this system, and what does that mean? What are the analogs? And so anyway, there's sort of have been various drafts of a bill floating around about who has the duty to report transactions for tax reasons, the IRS. And some versions have referenced DeFi, but it's unclear exactly what that means, because it's not clear who the right parties would be in DeFi for it. And some worries have been that this would accidentally hit even mining firms, which I think is not the intention. So, anyway, I know that I'm starting to come up to to time here, and I don't want to keep you guys too long. Hopefully this was at least a little bit interesting and useful for people. So, thanks so much for having me. Feel free to follow me on Twitter, ping me with questions, and most of all, hopefully you guys can help build out the future of DeFi and of crypto. And the biggest thing that I would say is try to build really, really amazing products. That in the end is what matters.
Thank you so much, Sam, for a wonderful presentation and that sound advice, because together makes us stronger. And obviously there's so much to do. And with someone like you leading the four, there is so much more that we can achieve. So thank you so much.
Thank you.
All right. If you'd just like to click on the red button in the bottom right-hand corner. If you'd just like to click on the red button in the bottom right-hand corner.
Hey, Duke, you're muted. You're muted on... You're going to have to unmute yourself.
Okay. Someone mute me?
No, you're still muted on your bottom left-hand side on your screen.
Can you see now? Okay. Hello. Oh, good now. Right. Okay.
Yeah, you're good. You're good.
What about now? Can you hear me?
Yeah, you're fine. Thank you. We can hear you now.
Right. Okay. So, but the earlier presentation was clear, right?
No. You were muted, so you're probably gonna have to start over really quickly.
Oh, the whole presentation.
Yeah, most people said they couldn't hear anything. So.
Wow. All right. Okay. So I was. Yeah. So in short, right, NFT is gaining traction. In 2021, in the first 3 months of this year, the NFT sales surpassed the last year's sales, the whole year, the last year's sales. 5 reasons why NFT is very important for gaming in the future, because of number one, rarity, indivisibility, interoperability, immutability, and non-fungibility. We're seeing great growth in blockchain-based games. Alien Worlds, Axie Infinity, which boasts now $2.5 billion in market cap, with a fully diluted market cap of $11 billion. And Axie Infinity, which is mainly played by Philippine players and also Venezuelan players. I was talking about how actual gaming can help. So Wolfenstein mod with Nazi cards turned into Smurf, Eon of Strife, which is a significant event in the mobile history, which is the mod for StarCraft, which boasted heroes, items, and bases such as Dota. I was talking about Dota, which was a mod for Warcraft 3 made by Kai Summer, which is actually the first mobile game that boasted tournaments. We have League of Legends now with nearly 120 million active players in 2021. That's 10 times, 20 times larger than World of Warcraft player base right now. We have Dota 2, which has the largest prize pool for any esports tournaments. It's going to be $40 million this year. So that's why we built our NFT marketplace to connect the game studios, the gamers, the artists, the developers. Think about the Nintendo game studio, Atari, Sega, where they have all those assets laying around doing nothing that they can actually be sold as NFTs. One, because it has a sentimental value for the game collectors, all lovers. Imagine buying the Mario Bros art, the Sonic art, or Space Invaders concept arts, right? And that's number one for collectible reason, and for being a fan. I mean, I would imagine I would buy myself such PCs. And number two is actual investment products. If there was, like, let's say, a Mario Bros concept art being sold, and it will probably gain value in the future, in 10, 20 years, then people would look back at that piece of art and would see that as an investment value. We built our NFT marketplace on Binance Smart Chain. Number one, because of the low gas fees. Number two, transaction speed. Number three is that there are a lot of Binance Smart Chain blockchain-based games already on Binance Smart Chain, and that would mean that we have an existing ecosystem of players and of investors built in this chain. Something that I've mentioned about early on is that proof of gaming is a truly unique concept, a truly revolutionary concept that we have thought about. So what we will be able to do is connect to our gaming client and play Dota 2 or CS:GO and mine altcoins. So obviously, with any consensus mechanisms, there will be an algorithm which will determine how much coin you will be able to mine playing those games, and it will be based on the time played in those games, on your rank, and on your play style. Those are the three main, let's say, pillars foundations of metrics which will determine how much altcoins you will gain. This is something that we are working on. We are talking with API providers, with Steam Data API providers, and we have the plan to release this at the end of this year. Our focus now is to build the NFT marketplace platform, which will be launched probably at the end of September, at the beginning of October. But our next goal is to actually, launch this proof of gaming at the end of this year. So stay tuned for more announcements. And for sure, our first game is going to be Dota 2, and that's a given. So there are three key takeaways from my presentation. Sorry for being muted early on. So that number one is that game development will be more decentralized. You may not have heard, but I talked about how I interacted with a lot of game studios, actually seeing the success of Axie Infinity and more crypto games. Those traditional game studios, they are switching their budget to invest to blockchain games. So I guess in 5-10 years, you will be seeing more decentralized ways of making games. And that will be also a push from the community, from the players, from the gamers themselves, who will, help those companies to adopt blockchain gaming to a wider audience. Let's imagine that there's like 2% of all financial assets in the world are now in crypto. So there's even less, assets in NFT gaming, but and that will provide a room for growth in terms of blockchain gaming. Number two is that play to earn will create even more pro players. For now you have tournaments, you can earn money by winning the prize pools, but playing games will actually be a way to earn money, and it's a job. And as shown by Axie Infinity, we have people who, Philippines is having one of the worst floods in years, but still people are still more concerned about playing Axie Infinity and actually earning money than about all the floods that is actually happening around. Number three is that new blockchain standards will come for gaming data. You will see a lot of API providers for different games. You will see, more consensus mechanisms for actually mining the coins from gaming. We are one of the first. We are one of the first to have proof of gaming, which means that this is going to be one of the first standards for blockchain and coin mining from games. So yeah. This is the company that I founded together with my CTO and co-founder, Wojtek. We have both extensive experience in both setting up companies and also, in software development in terms of building cryptocurrency exchanges and blockchain-based solutions. And yeah, thank you. And you can reach me out through my email or through my Telegram. Thank you. Yeah, so I'm going to move on with some questions in the Q&A section. How do art, engineering, project management, and production talent transition to this emerging industry? So first of all, you can join us by selling your arts as NFTs, and that's your first step to this emerging industry. But I guess what will happen is that more and more blockchain, let's say traditional game development companies, they will switch to blockchain gaming because of the sheer size of market capitalization, and also how much revenue they can gain by joining the blockchain space. So it is not you who will adapt to the new industry, but those companies that will probably hire you for the next project will switch that, and of course they will bring the whole industry together. Can you expand on proof of gaming a bit? Are you saying the better people, more money that they can earn? We actually have an article on our Medium or on Cointelegraph explaining a bit on how the consensus will work. This is in the work right now, but we will reveal the actual consensus mechanism near the launch. So there are 3 things that I mentioned about that will determine how much coins, altcoins, you will gain. Number 1 is your rank. The higher the rank, of course, obviously, you will be able to mine more altcoins. Number 2 is time played. Obviously, the more time you play the game, you'll be able to mine more. And number 3 is your play style, and that is something that will be determined on how how well you work with your other teammates. Are you a solo player or a team player or not? All those data, they will come from the Steam's API. Are you offering the ability to people to purchase in both fiat and crypto? You mean the NFT marketplace? As for now, only with BNBs and altcoins. Playstyle, and do you think the game companies allowing third-party APIs to connect, manipulate user data? We won't actually manipulate any user data. We'll just collect that. There are 2 ways. We first of all, we will partner up with companies which already have those data from Steam, from other games. I can't reveal you the partner yet because we are in talks, and once we sign the agreement, we can share with you. But first, as the first step, we will connect through the API provider, and they have now Dota 2 data, which is streamed live. I guess I have 1 minute left. How can you determine the fair market value of NFT owned without selling it? It's up to the seller who sets the price at the very beginning. From those 50 artists, some of them working for the Walt Disney, like Marvel Studios, or and other big name companies right there, and they set up the price. I've seen anywhere between $1,000 to $10,000, $20,000 per piece from our early artists. Yeah, so I guess that's it, right?
It is. Thank you so much, Duke. It seems like you had some great questions and very informative. And as I say, please do share on Twitter if you've enjoyed this talk, using the hashtag DeFi Conf 2021. Follow Duke and just let everybody know about this amazing conference on, of course, Duke View. Thank you so much, Duke.
Thank you.
Hi, everyone. How has your morning been going? I hope it's been a blast. We've had some great speakers, and we have another great speaker coming up, Mr. Alex Sevanovic. And so Alex Sevanovic is CEO of Nansen. Alex has over 10 years of experience in data science, management consulting, and cryptocurrencies. His academic background is in artificial intelligence and machine learning. As the CEO of Nansen, Alex drives growth and adoption of the blockchain data analytics firm to provide crypto traders, hedge funds, institutional investors, and VCs with insights into the crypto markets. Enjoy your talk, Alex. Over to you.
Thanks very much, Lavinia.
And VCs with insights into the crypto markets. Enjoy your talk, Alex. Over to you.
Thanks very much, Lavinia. All right. So, that was my background. My name is Alex Sevanovic. I'm the CEO of Nansen, one of 3 co-founders. I think I'll just bring up my slide deck right away here. Let's see. There we go. And I will present. Hopefully people can see that now. Today I'm going to be talking about NFTs and DeFi, specifically looking at market insights from on-chain analytics. So, as mentioned, my name is Alex Sevanovic. I'm the CEO of Nansen. Let me first talk a little bit about Nansen, the company, and what we do. So we are a blockchain analytics platform, and what we do, which is quite unique, is that we bring out the data from public blockchains like Ethereum, and then we enrich that data with wallet labels. So that allows you to effectively understand capital flow on the blockchain and what people are doing, but also which entities are doing these different things. So if you wanted to understand, the flow of Ether or stable coins or different tokens between exchanges, you could do that with Nansen. But you can also understand the different capital providers or liquidity providers to different DeFi protocols. And so what our customers use Nansen for is primarily three things, all a part of the investment and trading life cycle. The first is that they use it to discover opportunities. That could be yield farms. It could be NFT collections that have recently been minted. And once you've discovered those opportunities, you can also use Nansen to perform due diligence. So if you wanted to understand who's been providing liquidity into a smart contract, as I mentioned earlier, you can use Nansen to get a breakdown of those liquidity providers. And in some cases, we can even know, which funds or even angel investors and so on have provided that liquidity. The final thing you can do is you can also defend your portfolio by getting real-time alerts when certain events happen. So if there's a large transaction that takes place on the blockchain for a specific token that you might have invested in, you can get an alert through Discord, Slack, or Telegram to be made aware of this. Right now, we focus on Ethereum primarily, but we're broadening that to what we consider the broader Ethereum ecosystem. So it includes other chains like Polygon and also Binance Smart Chain, but also layer 2 solutions that we're rolling out, such as Optimism and Arbitrum. So that's briefly about Nansen, so you have that context. And today I'm going to be talking about, as I mentioned, DeFi and NFTs. We're going to be looking at some trends or observations within both DeFi and NFTs. And we're also going to briefly talk about where DeFi and NFTs meet at the end. So I think the key thing that has changed in this market cycle versus the former one in 2017-18 with the massive run-up is that it's a lot easier now to track what the smart money is actually doing. And with Nansen, you can also track what the biggest VC funds do, what the biggest market makers are doing on-chain, and so on and so forth. So here's a screenshot that just shows various different entities, some of them known, like Alameda, which is a big market maker and trading desk, as you probably know. But you can also see other behavioral labels like Smart LP, which is a smart liquidity provider. And I think a unique thing of this cycle is that you can now track this. And in the past, it used to be the case that you were pretty much trading in the blind. And many people have told us that, after they started using Nansen, they can now see. Before Nansen, they were blind, but now they can see, which I believe is a verbatim quote from one of our customers. So this is one trend that we're seeing now, and that also makes the whole investment experience much more social, because you start considering who else is investing in this token, right? Who else is picking up this NFT collection? And that suddenly becomes one of the key information pieces that you have to take into consideration when you do due diligence to make investment decisions. I think another thing that I think is quite interesting is that because of the transparency of blockchain, which is quite unique if you compare it to something like traditional finance, is that every single wallet that you can inspect on the blockchain is potentially a masterclass. It is potentially an address that you can study and learn from. And so here's a screenshot just from one of the wallets that we plugged into our wallet profiler dashboard, and you can see which different protocols this wallet has been interacting with regards to incoming Ether and outgoing Ether. But you can also see tokens that are coming in and going out as well. Everything from USDC and DAI stablecoins, right, to Alchemix, Maker, governance tokens, and so on and so forth. And you can actually spend quite a lot of time looking at these smart money wallets to figure out, what are they doing on the blockchain, and perhaps you could be doing similar things. And so this is another example of how trading is actually a very social. It's a very social thing that you can do on the blockchain. So maybe a bit controversial, but you can also look at, say public figures wallets, right? Sometimes they will go public with which wallets they own. And this is particularly common in the NFT space because NFTs are uniquely assigned to an owner address, right? Any NFT that someone is showing off, if it is a unique one, will reveal the address of the holder. And so Mark Cuban has famously posted tweets where he's, looking at NFT projects, has invested in NFT projects, and also DeFi projects. And within Nansen, you can see some of these labels that they would get associated with them. And so obviously there's the Mark Cuban label itself because he is a public figure and has, opted to share with the world that he owns this wallet. But he also has a few interesting behavioral labels. So uncommon NFT collector means that this wallet is in the top 10% in the number of NFT transactions, or ERC 721, which is a standard for NFTs. You also have a heavy DEX trader label, which means that they have made trades on DEXs. And in fact, the heavy qualifier means that they're in the top 1% in number of trades or in volume traded, but not both. If they would be both, they would be classified as an elite DEX trader. But so clearly they're using this wallet to make DEX transactions, which is something I'll talk about a little bit later. We can also see that they're a sandwich attack victim. And this might be a little bit technical, but effectively sandwich attacks are something that can happen on the blockchain where you get front run if you're trading on a decentralized exchange. And in this case, we can see that Mark Cuban's wallet has actually been front run at least once, and they've been tagged as a sandwich attack victim. That's not uncommon. In fact, you might be surprised to learn that your own wallet was at some point sandwich attacked, where a bot intervened effectively and was able to front run you and pick up, say, some tokens right before you wanted to buy them and then sell them right back afterwards, so that you ended up with a worse price than you would have gotten if that had not happened. So this is interesting stuff that you can actually pull directly out of the blockchain, and it's one of the key things that we focus on at Nansen. I think one more macro observation that I would highlight in terms of DeFi trends is that since the last bull run in 2017-18, decentralized exchanges have really proven product market fit as a category of products. And I think this is really one of the best examples of how blockchains are useful and how, in fact, many people are moving from centralized exchanges onto decentralized exchanges. And I was listening to a podcast with Eugene or Evgeny from Wintermute, a market making firm, and he effectively said that eventually he believes all of the liquidity will move to decentralized exchanges, and the argument is quite simple. Effectively, if blockchains work, if blockchains are a good technology, then of course the trading should happen on the blockchains, which means on DEXs, right? And if blockchains do not work, well, then the whole crypto sector will probably implode, including the centralized exchanges. So it seems like there's a trend towards DEXs in terms of volume. There's still challenges, of course, to tackle, and there's a lot of innovation happening, for example, around this front-running challenge and other challenges that exist, throughput and so on, transaction fees, slippage, all these different things. But there's no doubt that there is very strong evidence of product market fit for DEXs, which is a really exciting trend, I think, personally. Of course, another thing that many people are aware of is yield farming. And so there's a lot of stuff you can say about yield farming, but and most people might know what this is, but effectively this is when you are typically providing liquidity in some form, and you're rewarded for providing liquidity by getting a governance token of whatever project it is that you're providing liquidity to. The thing is with yield farming is that a lot of it is quite mercenary. And so we found that 42% of yield farmers that enter a farm on the day it launches will exit within 24 hours. And so that shows, first of all, how fast these markets move, but it also shows that there's not always a lot of loyalty when it comes to, actually collecting these liquidity rewards. And we also found that around 16% will leave within 48 hours. And by the third day, 70% of these users will have withdrawn from the contract. And one of the reasons, of course, is that basically the emissions or the yields that you're collecting over time will decrease over time as more people come into the farms. And so people will move on to the next thing. So effectively, the capital is often quite mercenary in DeFi, and users tend to put their capital to work where they get the highest yield. So that's another trend that we have observed purely by looking at the on-chain data of what people actually do on the blockchain. I think here we start moving into NFTs. And NFTs, I mean, there's a lot of stuff you can say about it. I would say it's another great example of product market fit for blockchains. And again, they had a bit of a slow start with, obviously CryptoKitties was huge in 2017, 2018. But after that, there was, not a lot of enthusiasm around NFTs for a long time. Recently, we've seen a lot of enthusiasm for it, a lot of trading volume, a lot of activity, lots of projects being, issued and born every single day, which I'll get back to a bit later in the presentation. But they're a great example of how blockchains are useful and how, in many ways, they're changing industries beyond finance. Because NFTs, they touch on art, right? Digital art. They touch on gaming. They can even be used for things like real estate or insurance policies. So they're, in many ways, almost like a pseudo category. They are actually used for a lot of different things. And it is possible to believe that NFTs can be extremely valuable in one sector, but not so valuable in another one. For example, one sector that I personally believe in a lot is gaming. So I think NFTs are going to be massive when it comes to gaming because there's already economies within these gaming universes where you can buy and sell items. And it seems absurd that you should not be able to actually own these items outside of the game itself. And so being able to bring out gaming items and so on from different games and then perhaps bringing them onto other games or into other ecosystems seems like an obvious trend that will happen. And there's a lot of evidence of this already with projects like Axie Infinity, Decentralised, where you can buy virtual real estate, crypto voxels, right? Metaverse-oriented projects, which have effectively driven a lot of the enthusiasm for NFTs. But another thing that has been very hot recently is, of course, NFT collections. And new NFT collections are born literally every day. Several new collections are born every day. And one of the things we do in Nansen is we have a suite of NFT dashboards. NFT Paradise is where you start, and that's where the screenshot is from. This shows the top collections in terms of trading volume on the Ethereum blockchain. And so you can see a lot of different things here. In this screenshot, you see that CryptoPunks, which is one of the more classic NFT collections, is at number one with more than 7,000 Ether worth of trading in the last 24 hours. You also see other projects like Bored Ape Yacht Club, Art Blocks, and a more recent one called Robotas, which if you see at the right of this table, you can see that when we took this screenshot, Robotas was created as a smart contract only 31 hours before. So, you can actually use this dashboard to get informed of new NFT collections, and literally every day we see a new one pop up on the radar. This tends to spike gas prices as people mint these new NFTs and become, the primary owners of these NFT items. And then afterwards, there's a lot of really interesting market dynamics where some people are trying to flip them, other people are trying to figure out which ones are the rare items. And of course, all the community building that crypto is known for takes place around these NFT collections as well. So this is a really interesting trend, I think, and there's been a lot of activity around the NFT collections that get issued on the blockchain. But one thing that's important when you look at these NFT collections is to perform some due diligence, right? So you don't only want to know, what's the hottest one right now. You also want to get additional information on things like what does the trading volume look like over time, which you can see there down to the left. But you can also see what about the prices, right? NFTs are different than fungible tokens or sort of the normal tokens that we're used to, in that every token is unique. So that means you can't come up with one price for the whole collection. You have to look at the pricing ranges. So typically you look at a floor price or a minimum price within the collection. That's the red line that you see down to the right. And you can look at the highest price within that day, which is the blue line. And then you can look at the average price, which by definition will lie between those two lines. And this can inform you, what does that distribution of pricing look like? Are people buying up sort of the floor tokens, which would basically means the cheapest tokens in that collection? Or is this one where you want to look at the more rare tokens? That's, where the primary value lies. These are, all things that you can figure out by just looking at the on-chain analytics. And, you can also look at who is actually buying these, right? And so figuring out if NFT influencers, different investors are putting funds into these collections. That's, another thing that's very important. So a bit more on NFTs. So we also have a feature for NFT leaderboards, and this shows the top investors. And so this slide might be a little bit dense, but the highlight here is that you can identify the top investors in DeFi. And if you look at Pranksy, who's a well-known NFT influencer, he's spent close to 2,000 Ether on NFTs, and he has made some incredible profits by basically purchasing those and selling them off later at a higher price. Of course, he ends up holding some of these tokens as well, but he's been a very important figure in the space of NFT collections. But you also have other investors like @blank.eth, which is an ENS name, right? An Ethereum name service username that you can see on the blockchain. And they have more than 5,000% profits on investments. And you can drill down and you can look at the realized gains per NFT collection. But this is just some of the stuff that you can pull out from the leaderboard. And it's pretty interesting to see what people are doing investing in NFTs. Okay, so what about DeFi and NFTs? Where do they meet? Where do these worlds collide? I think one good example is Uniswap v3, where effectively, if you're a market maker or liquidity provider on Uniswap v3, what you actually own is an NFT. So the NFT represents the funds and the range in which you want to provide those funds or that liquidity for a specific pair of tokens. And so this, again, sort of reinforces the point that NFTs are actually a really broad category of digital assets. They're not just used for digital art. They're not just used for gaming. They can also be used for, pretty technical implementations of decentralized finance as well. And so this is, I think, a pretty interesting example of where DeFi and NFTs meet. And a cool thing that Uniswap did was that they created these sort of generative art pieces that uses some of the data from the different liquidity provider positions. And you can see them very visually if you look at them on OpenSea and so on, which is a pretty cool and creative idea. And many people ask us, what about DeFi and NFT usage? Is it this? Do we see the same people engaging with DeFi as people who engage with NFTs? And I think the answer here is a bit nuanced. So if we literally just look at the on-chain data, and you can classify wallets into different buckets, you can say how active is this wallet trading on DEXs, and you can also look at how active is this wallet trading NFTs. You can see that there's actually a bit of sort of like an all over the place type of view here, where you have people that fall into all sorts of categories. But generally speaking, there is some correlation where the more active a user is trading in DeFi, the more likely they are also to be an NFT collector, which makes sense because, people, they're operating in the same space. They know how to use wallets. They have liquidity in their wallets, right? And they might want to put some of that liquidity into NFTs. But there are many users who effectively only have an interest in either NFTs or DeFi. If you speak to DeFi investors, many of them don't really understand the enthusiasm around NFTs, and they're not really interested in it. They are happy basically just trading tokens, providing liquidity, making perhaps seed investments in projects around DeFi and so on, but NFTs is not something that they are interested in. And conversely, more and more, we're seeing people who are interested in NFTs, but they have zero interest in decentralized finance. They have no interest in, market making, trading, leverage, none of that stuff. What they care about is the sort of game of collecting NFTs, for example, or participating in these different metaverse communities. So I think this is actually a super interesting research area, and I would love for us to do even more research on the overlap. But what I would expect is that over time, we will see more and more of a decoupling, and the NFT space on its own will basically, in many ways, decouple from the rest of the crypto market. And you can sort of see it to some extent already as the Bitcoin price and, price of Ether to some extent has moved sideways. Ether has been moving up a fair bit lately, but there's generally been sort of a consensus that we're going sideways in the market, but NFTs have been pumping. So premium NFT collections like CryptoPunks, Art Blocks, Bored Apes, prices have just been going, through the roof. So I think this is a really interesting maturity sign of the crypto sector, where you see different markets popping up and you don't see a strong correlation between everything that happens within crypto. So with that, I think I'll open up for a couple of questions, and I'll close the slide deck here so I can actually see if there are any questions in the chat.
So, hi, Alex. You've got about less than a minute to take a question.
Okay.
Great
Let's
presentation.
See. Okay, I'll try to be quick. What is Flashboy? This means effectively a address that has been active in flash loan activity. So the name Flashboy comes from a book by Michael Lewis called Flash Boys about high frequency trading. So that's where the name comes from. To which extent do you think exchanges which are marketed to be decentralized are technically and literally really true? Good question. I think the term decentralized is in many cases an aspiration. Of course, it gets more and more relevant as regulators start getting involved, and decentralization actually becomes quite important. In addition, of course, custody of funds and things like that is very important. But there is a scale. Like decentralization is not a switch. It's not either or. And yeah, I think the next question was probably the same one. So I think we managed to finish there on time.
Perfect. Well, thank you so much, Alex. And as I like to say, please, guys, go on to Twitter, share, like, and use a hashtag DeFi Conf 2021. Thank you so much, Alex. Hi, everyone, and we're back with two other great speakers. This is a special session where Aiden Diego will be interviewing Diego, guitarist. So, Aiden is from South Africa. He grew up in apartheid and is a family of people who, for generations, had been causing trouble for authorities. Growing up stories around his family fighting the Nazis and escaping Soviet Russia, which was why he grew up in South Africa. When Diego discovered Bitcoin in 2011, he started getting involved because he understood how Bitcoin allowed for families around the world to have sovereign control over their destinies in a way that was never before possible. He is currently a contributor to Sovereign, a Bitcoin DeFi project that aims to be the premier financial operating system secured by Bitcoin proof of work. Diego, he is the co-founder of RSK Labs that made Bitcoin fully programmable by providing smart contracts. He has also been a pioneer of blockchain and Bitcoin development in Latin America. He co-founded the Argentine Bitcoin NGO with over 5,000 members registered at the meetups and 30,000 members in its online community, and the first Bitcoin center in LATM, Latin America. He is also president and co-founder of the Bitcoin Latin America NGO, where he helped create a network of Bitcoin communities with presence in 9 countries in the region and the longest running Bitcoin conference in the world. So without further ado, I'll leave the stage to you, gentlemen. Thank you.
Thank you.
Thank you. Thank you very much. I think we will be interviewing each other even, no? That's the idea.
Yeah, it looks like it. So I think we met for the first time, I think, in Argentina at the La Bitcoin conference.
In 2013, at the end of 2013. Mm-hmm.
Yes. And I think we were both drawn into Bitcoin for the same reasons, right? So we both grew up in places where the government spent all of their time explaining to us how monetary policy shouldn't be run by them, yeah?
Yes, and yeah, absolutely. And systems that were not, that also limiting freedom for people, no? That because it was not only economic controller, but also that implies some of the individual liberties, no? That was limiting individual liberties as well, no? Money is the blood of our society. So
every time I go down to Argentina and I talk to people there, people tell me everyone has a story about how all of their money got confiscated. The banks de-dollarized and then turned their dollars into pesos, which were worth nothing. How bank accounts got closed, and how obviously, through the hidden tax of inflation, people lost a lot of money. And I know that you've experienced this a few times in your lifetime, yeah?
Yes, I think Corralito, that's the phenomenon you mentioned, that was maybe the more traumatic event, happened in 2001. And it was terrible. You could see the sadness of people in the streets for a couple of years after that happened. And people lost their life savings because the bank said, your money is not your money anymore. We will hold it for you. That went for a year almost. And when people was able to get out, their money was worth 1/4 of what it was before. But some people, in desperation also, like they only let some very specific ways out, and some people in desperation lost even more than that, because imagine that all your life savings, the money, like the elderly had their retirement funds there, like it was devastating. And then I think that was the first realization that your money is not your money in the traditional financial system. So for us, like when Bitcoin started, I also, like you, connected with Bitcoin in 2011, but I didn't see or understood the full dimension of Bitcoin until 2012. But once I did that, for me, was the reason why Bitcoin was necessary was so obvious that then I decided to devote my life into it, and that's what I've been doing since 2012. So we don't need to explain why Bitcoin is necessary or relevant in Argentina. It's like, it's very easy to understand.
It's interesting. I've been looking at some polling that has been done recently. The country with the highest number of Bitcoin users in the world is Nigeria, with more than 35% of the population having used Bitcoin. Other countries like Turkey and Latin American countries also have very, very high numbers. And I think it's because, probably the reason that we were able to connect with Bitcoin so early is because we had the personal experiences. I've spoken many times about, having to smuggle gold out of South Africa to get money to my family. But when I was just a very young boy, the Rand was de-dollarized and lost its peg to the global currencies. And my grandfather, who was very sick at the time, was suffering from colon cancer, suddenly discovered that his loans, were now worth more than everything he owned, which, and eventually it killed him. I mean, it really accelerated the rate at which he was getting sick.
And so I think, we have very personal stories that maybe a lot of other people in this already developed world haven't experienced yet, but unfortunately it looks like might experience more in the near future. I think one question, Diego, that a lot of people have told me, have asked me about, and you know a lot more than I do, is what is happening with Bitcoin in Latin America. El Salvador is in the news, Paraguay and Uruguay are in the news, Argentina, Venezuela, and Colombia have all seen growth. What do you see happening?
Yeah, and yesterday Uruguay, when a congressman presented a similar proposal, not exactly the same, but a proposal to also accept cryptocurrencies or as legal tender or close to it, or to formalize the acceptance. So I think I think what El Salvador, this has been brewing for many, many years. No, we started building communities in Latin America in 2013, first in Argentina. Then I was traveling to Chile, Montevideo, but at the same time we were connecting with people in Colombia, Mexico, in Brazil, that they were starting to build the communities. So these, indeed, in the numbers that they were sharing today, they are double that. It's like the online, communities, like 80,000 in Argentina people. It's 10,000 in the meetups. It's like everything has been growing like year after year. And what's happening is like Bitcoin is becoming kind of a backbone. And that was a little bit of our initial vision, a financial backbone in a region that is completely diverse. It's like Latin America is not, people talk about Latin America like a monolithic thing, no? But Latin America is nothing like the Eurozone or Europe. It's like Latin America is a group of very different countries in terms of political structures, financial models, even legal backgrounds, and that are connected by some cultural elements that connect them. But other than that, like moving around Latin America is very tough. There's a lot of friction. It's very tough to move money from one country to the other. They are not really connected. And I think Bitcoin is sorting out two of the main problems of Latin America. One is this kind of patchwork that Latin America is in terms of financial systems. And so it creates breaches between Latin America. People have been using crypto to send money to their families back in Venezuela from Argentina for a long time now. And also the other problem, that is half the population in Latin America is excluded from the traditional financial system. The traditional financial system, it's far behind, so it's not being able to serve the half the population, and people don't trust the system as well because of the things we were mentioning early on. So crypto is providing an alternative for people who have no alternative, and creating financial inclusion. It's like
right.
It's like as we both think that this is not an alternative system, but what we are building is the future financial system. It's just been developed so far, but I think it's also like leapfrogging the region into the next financial system. It's like the same that happened in Africa with the mobile phones versus the landlines. Landlines never get to well, I think the traditional financial system, it will never get to everywhere, to the population of Latin America.
One question, but from my experience in Latin America, there seems to be much more emphasis on Bitcoin than, let's say, Ethereum or other sort of alternative currencies. Do you think that impression is true? And if so, why?
It is true, and basically because Bitcoin over time has proven to be the best store of value. And that's the other thing that people is looking to in Bitcoin in Latin America, like the local financial systems. Argentina, for example, has 50% inflation per year. Imagine that. And on regular basis. I'm not saying, well, this was a crisis year. It's like, it had like 25-30% inflation every year for 12-15 years. Then it spike out, and now it's like around 50% inflation every year. So when you have that situation, you need to go somewhere else. People who was doing some weird things like buying goods as a store of value. Like if you have you're a shop owner, instead of like what you do is buy goods, because goods will preserve value better than the peso.
Right. So you hold commodities. Exactly.
Exactly. You hold commodities. You hold so in that sense, is a complete different mindset, and Bitcoin fits perfectly into that. So people is looking, and this will be extended also to stable assets, of course, no, because stable assets, people has been acquainted to the dollar for a long time as well. So that was, I would say, I think, if I'm not, I mean, Argentina is the top word in terms of dollar holdings in a country outside the US.
Right.
So that's the level of
So we're starting to get some questions from people who are watching. I think it would be interesting to address some of them. So one of the questions that someone is asking is how you deal with fiat on-ramps and off-ramps. I think one of the interesting things about Latin America generally is that there's very well-developed fiat on-ramps and off-ramps which are informal, right? The ability to go and buy the blue dollar in basically any main street in Buenos Aires, and the same thing in Colombia, and the same thing that you experience in Honduras. And so there's a very strong informal economy allowing people to go in and out of crypto. And maybe it would be interesting to talk about how people have been using that with Bitcoin and with stablecoins.
Yeah. Well, we have witnessed lately, as you say, you have this phenomenon of OTC brokers, like over-the-counter brokers, and this, like, I would say, informal network, because it's not tied to ILNs or anything. It's just informal. It's not money transfer, money conversion. They call them little trees because they have the green leaves that are the dollars over them. These guys that are exchanging, guys and gals that are exchanging dollars. So that already exists in Latin America. Now what we are seeing is that they are shifting all these. They are shifting into Bitcoin and stable assets. So you have. So that's. I mean, it's the structure, the infrastructure, the mindset was already there. Like, people was hedging against their states, basically the monetary policies of their states for many years. And now what they are doing is moving into new rails. And that's because if you think about that, Bitcoin is digital gold, but it's very tough to get physical gold. It's like, it's very, very, very tough to, that for first hand experience, but, getting access to physical gold, carrying it, transporting it is very tough. Protecting it is very tough as well. So basically, I don't see this as an alternative system. It's like new rails, new financial rails that are being built, that are open, neutral. They don't judge who participates, so they are open to anybody, and they don't have a political sign. Well, maybe it's a political sign that they don't have a political sign, but so what is happening is that all the systems that people have in place are moving into this new infrastructure. No? And in our case, we believe, I think you and me believe, that the foundations for that new financial system is Bitcoin. No, for many reasons, maybe we can get.
So why, the panel is called DeFi on Bitcoin.
DeFi, yes.
And I think there's an interesting difference between decentralized finance on Bitcoin and decentralized finance as it has evolved on Ethereum. So in Ethereum, what we're seeing is a lot of financialization, right? So people are yield farming, and there's collateralized lending and a high degree of leverage. What we're seeing with Rootstock and with Sovereign and with Tropicus and other projects like this, where and sort of Lightning Network and other layer 2 systems which are building financial economic systems on top of Bitcoin, is they seem to have a different flavor, right? Maybe you can talk a little bit about how that is evolving and the different projects that are in the space.
Yeah, I think the vision with which we started Rootstock, and I think the same goes for Lightning and Liquid and other layer 2 systems, is like, Bitcoin is the safest decentralized network in the world, no, in terms of infrastructure, in terms of the protocol is the safest protocol you can have in a decentralized form, and safetiness comes at a cost, no. So it's like Bitcoin decided by design to sacrifice scaling and sacrifice functionality, and that's a trilemma. It's like, if you have decentralized systems and you want to have maximum security, you have to narrow the surface of attack. Therefore, you have to sacrifice functionality, and the settlement process needs to be have sufficient time to actually come to an agreement as a network. And also, you have to sacrifice scaling, because networks that do thousands of transactions per second or hundreds of transactions per second, because of the nature of blockchain that keeps all the data, grows at a rate that in a few years they become centralized. It's like, who is going to store a multi-terabyte blockchain in their computer? Nobody. So you lose the ability of independent validation that is part of the ethos of Bitcoin, like how we keep give the users the power to really validate what's going on the network without intermediaries, because it's all about removing intermediaries and creating a peer-to-peer financial system. So how Bitcoin is growing by second layers. And I always talk about the Internet of Value, because I think it's the same model that the Internet of Information had. So you have this OSI model where you say, okay, this layer will take care of this, moving data. This layer will take care of this, like presenting data to the user. Okay, in this case, it's like the Bitcoin layer is taking care of, basically storing value. And that's the core thing. And then you have layer 2 systems that take care of different things. Lightning, smaller payment processing, faster, cheaper scaling. Liquid, maybe a backbone for financial institutions working on Bitcoin. And what RSK is doing is adding open economic coordination layer on top of that.
Right.
And that economic coordination can be used for multiple things. The most obvious thing is DeFi, is creating a full-fledged decentralized financial system that is where Sovereign, is working, saying, okay, how we build a full financial system that, serves everybody using the same infrastructure of RSK. And then, in the long-term vision, we are also building infrastructure, decentralized infrastructure, like decentralizing the web, but creating all that infrastructure economically coordinated in RSK, secured by Bitcoin and run by people. So we have a peer-to-peer internet. So if you look all that together, we will have a truly peer-to-peer financial system and a truly peer-to-peer infrastructure. So basically, we are operating on a peer-to-peer.
So Naveen just asked, do you mean that dApps are being created on layer 2 Bitcoin, right? So Rootstock is a Bitcoin sidechain, and it's mined. So it's mined by Bitcoin miners, and the native currency is Bitcoin. So you move your Bitcoin from layer 1 to layer 2 into Rootstock. And then, what I've been very involved in is contributing to a protocol that's built on top of that called Sovereign. And what Sovereign has done is create a platform, an operating system of smart contracts, right? And so you can do lending and borrowing, you can do trading, you can do margin trading. And we're starting to introduce tools on top of this, like the ability to do Bitcoin-backed stablecoins. So we're now aggregating different ways of collateralizing stablecoins and creating Bitcoin-backed stablecoin, and we're integrating with Lightning Network. And so I think what's really exciting is that this allows us to start offering maybe more day-to-day economic needs for a lot of people, right? So we're starting to offer loans that are backed by Bitcoin using Bitcoin-backed stablecoins. We are able to start having people from anywhere in the world begin processing these transactions, and so we've been focused on Latin America and Africa, and we're also starting to see growth and a lot of the liquidity coming from sort of Europe and the United States. And I think that this connects to another question, which is, Shofar asks, El Salvador is seeing issues with BTC fees being too high, right? And so what we've always seen with layer one systems, Bitcoin, and then even more so with Ethereum, is that the fees get very, very high, and then it becomes very exclusive, right? So like one of the things that I always thought was sad is, the Ethereum community, for example, hyper-inclusive from a cultural perspective, but the Ethereum chain became the most exclusive blockchain in the world, and only very wealthy people could afford to use it or trade on it. But by having layer 2 scaling, you can now have Bitcoin transactions occur very, very cheaply, much, much more quickly, and then you can also have much more composability, like the ability to have to take that Bitcoin, use it to collateralize stable assets, and allow people to know that those stable assets aren't relying on the Argentinian government, aren't relying on the Venezuelan government. They're relying on code.
Yeah, and I think, that's maybe we can switch sides, but because I want to learn a little bit more of your journey, like building the community and the challenges. But I think you touch like a very good point. It's like what we are building is a full P2P financial system, and that implies also to having a P2P monetary system. So that's where having Bitcoin as collateral to issue stable assets, that's what the money on chain protocol is doing, is like it's essential for the system, because at every point where you need to go out of the system to sort a problem is a point of centralization, is a vector of attack for the whole thing. So you have digital gold, that's the neutral store of value. And I think there's a lot of questions on why not using platform A or platform B that is cheaper. Like, I think this is not about like the short-term solution. It's about building things that will last decades. And that's why, we are building on Bitcoin. It's like, yeah, of course, there are platforms that in a way hijack, like say, okay, I will do this trade-off and do my own platform. But then in the long run, and I'm all in favor of diversity, as you were saying, Ethereum is an awesome ecosystem, very inclusive. But then, you see the consequences of those trade-off or moving fast and breaking things on layer, on protocol layers. It's like on protocol layers, you want to move slow and make sure that you are building things that will last for decades. And in that sense, the scaling problems have been solved already, and the Ethereum community did huge contributions with the rollups technologies, what I call payment aggregations as a concept. Like, and we are all profiting from that, because we are like RSK is fully compatible with Ethereum, so anything that is developed in Ethereum can be ported to RSK but be secured by Bitcoin. So why not X platform or B platform in our vision? Because it's not the only vision. It's like everybody is free to develop what they believe into. But in our vision, the true reason to build all this decentralized financial system, the P2P monetary system backed by Bitcoin with stable assets, then all the financial services that Sovereign and others are building in terms of lending, margin trading, then the DEXs, the exchange of assets, like fully decentralized way, and then the scaling protocols on top of that to serve billions of people. We are building everything on Bitcoin because we believe that Bitcoin is the right foundations. It's like, if you want to build a skyscraper of, 100 floors or 200 floors, you need to go down and dig deep in order for that thing to sustain. So it's not about what we can do today. It's not about what we can do a year from now. It's about what we want to do a decade from now, where we hope this financial system will be the financial system of the world and will host trillions of dollars of value of people. And we want to make sure those trillions of dollars are safe from censorship, from governments, from different political attacks. So we protect sovereignty of individuals, which is at the end the ultimate goal of what we are doing. No,
right?
But
yeah.
Sorry, I tend to overextend, but I would love to learn a little bit more about your experience building on Bitcoin and building, like, because of course you started in the Bitcoin community before we even have other cryptocurrencies, smart contracts, and also. So what about that experience?
I mean, my feeling is that Bitcoin. What excited me about Bitcoin wasn't just the fact that it was sovereign money. It was the fact that there was a community behind it that was interested in the courageous attempt to build out and innovate new ways of generating freedom for people. And I think what happened with the 2016-2017 block size wars is the Bitcoin community kind of became allergic. Its autoimmune system became overstimulated, and it became allergic to new ideas because some of the new ideas were so bad. And what we're starting to see now, and one of the interesting things that is happening with Bitcoin DeFi, right, is that I think it's inspiring people to get excited about Bitcoin again, to see how Bitcoin can be leading the charge in providing for a new, transparent, borderless, and permissionless economic system for the future for everyone. And so the battle that we have, like when we're building Sovereign, right? So Sovereign now manages tens of millions of dollars worth of value. It's got tens of thousands of people in its community, and it it processed over $500 million in transactions right now, and the whole thing is secured by the Bitcoin network and is permissionless and decentralized. And yet we still need to explain to people why this is important, why this is interesting. But I think the number one thing that my experience has been is that as more and more Bitcoiners learn about the Sovereign protocol, the reaction that we get to is finally, right? The reaction is, this is what I've been waiting for since 2014, right? Like, obviously, if you're going to have a decentralized monetary product, you want to be able to use it without going through intermediaries. Otherwise, there's no point. So using Bitcoin on BlockFi or on exchanges or, through an ETF, none of these things, I think, were ever the Bitcoin dream. And they are sort of compromises that we've made in the short term as we've been moving towards building the technologies for truly decentralized use of Bitcoin. And those technologies are here now. So I think we're in a new renaissance for Bitcoin, and maybe the most exciting period for Bitcoin since the beginning.
I agree. I think we started with a dream back in 2000, like almost 10 years ago in Bitcoin, and now that dream is becoming a reality. No, now it's something tangible we can use, like a fully decentralized financial system. So yeah, it has been a long journey, and now it's
not over.
No. It's just starting. Actually, it's the fun times are just starting. Is like the best moment to be in Bitcoin is today. So.
And on that note, we're going to have to wrap up a wonderful conversation. We were just discussing in the background about Bitcoin and the importance of Bitcoin being brought into this conversation. So it's great that, the both of you are doing that and sharing that message with the community. So thank you so much for your time. And we look forward to further conversations on this topic.
Fantastic.
Thank you very much.
Thank you.
Welcome to another session with an awesome speaker. This speaker is Mr. Jesus Rodriguez. He is a technology expert, serial entrepreneur, angel investor, and internationally recognized speaker and author. A computer scientist by background, Jesus is the CEO of Into the Block. I love the title. A platform that leverages advanced machine learning to understand and predict crypto asset markets. Jesus is also the chief scientist and managing partner at Invector Labs, a development studio focused on leveraging deep technology trends such as artificial intelligence or blockchain technologies in real-world applications. Jesus has been the recipient of several industry awards, including the Inc. 500. He serves as a board member in several enterprise software companies, and is an investor in over a dozen startups. Welcome, Jesus. We look forward to your presentation. Enjoy.
Very much, Lavinia. Happy to be here, and thank you everybody for joining us. Today we're going to be talking about high frequency trading and decentralized finance. So we have a lot of ground to cover, and I just need to check how to share my screen. Okay, perfect. So we have a lot of ground to cover, a lot of slides, a lot of content. So I'm gonna go very quickly, but please feel free to use a Q&A at any given time, and I'll stop for questions throughout the session. So hopefully today I'll be sort of demystifying some of the ideas behind HFT and DeFi and presenting some sort of ideas about strategies, about building blocks that you should look at if you're sort of interested in trading in the DeFi space. A little bit about myself. Lavinia did a little bit of an intro. I'm the CEO of Into the Block. So we work at the intersection of machine learning and crypto. I have had a career in tech that includes 10 years at Microsoft and Wall Street building quant systems, a couple of exits as an entrepreneur, very active investor in both machine learning and crypto. Teach at Columbia University as a guest lecturer, published what I would say is a decently popular machine learning newsletter at The Sequence. And every day I get the opportunity of applying machine learning techniques to crypto assets as part of the work that we do Into the Block. So we leverage data science to extrapolate insights about crypto assets. Our analytics platform has over 170 clients, including some of the most prominent brands in crypto. We also have, we work on quantitative trading strategies that we execute with some of the top crypto asset managers in the space. Here I cannot disclose a whole lot, but our strategies process hundreds of millions of dollars in DeFi trades regularly, and a lot of the ideas that we apply in high frequency trading is what we're going to discuss in this session. The agenda for today is very, very simple. So I'm going to talk about HFT from a decentralized finance perspective. Then we're going to spend a few minutes talking about some of the key building blocks of building high frequency trading strategies in DeFi. And I would like to leave you at the very end with some, let's say, more futuristic ideas about DeFi and HFT. As I said, at any given point, feel free to use the Q&A panel, and I will stop for questions. So DeFi and high-frequency trading. High-frequency trading has been always about speed. Since the very beginning, it's a discipline from the 1970s, became popular in the mid-2000s, but the idea of leveraging the speed and information has been around forever. One of the famous examples is Nathan Rothschild during the Battle of Waterloo. He was able to obtain news about the victory of the Duke of Wellington ahead of the time that the news reached the London Stock Exchange. So there were rumors that Napoleon was winning the battle and the bonds of the British government collapsed. The Rothschild family was able to buy those bonds and then sell them when the news finally arrived that the British has won the Battle of Waterloo. As markets became electronic, high-frequency trading became a common discipline, but it was very obscure. Not many people knew about it. It was highly popularized in with the Michael Lewis book Flashpoint that sort of shed a light into the industry and the practices. And fun enough, this book came out just weeks before the first HFT company, Virtu Financial, was scheduled to go public. And the backslash of the book was so strong that they need to postpone the IPO. So in HFT, in traditional market, there are many types of strategies. There are traditional strategies that arbitrage inefficiencies of indices that are mispriced. There are strategies that take advantage of events like news or M&As or things like that. There are strategies that just do arbitrage based on statistics across different venues. There are things that are just based on trying to front run a specific order. So there is different type of HFT strategies, but they're all based on speed. So one of the bad things about HFT is that the innovation in terms of technology and technique hasn't been there. It's been mostly about being faster than anyone else. But you still need to deal with intermediaries. So you still need to deal with market makers. You still need to deal with centralized exchanges and things like that. So decentralized finance introduces some new dimensions to the way that we traditionally think about high frequency trading. In general, if there is one takeaway that I want you to learn from this session, is that DeFi HFT is not about speed anymore. There are other factors that add some different vectors that you should evaluate when you think about high frequency trading and DeFi. For instance, there are factors related to the block time at which transactions can be processed, the fact that everything is visible on the blockchain, the fact that transactions have a cost, the role of miners, as well as the risk that you're taking on the protocol side. Let's break down one by one each one of these factors. So, for instance, traditional HFT has always been about speed, but in crypto, you're subject to the speed miners can produce block. So in the Ethereum blockchain, that's every few seconds. So it doesn't matter how fast you can execute a trade. You always have that delay. So speed is not that much of a factor anymore because you cannot be faster than the block producing time, which sort of introduces a new type of strategies that you need to think about it. Also, HFT have been traditionally obscure. If you're trading with HFT strategies in traditional market, you for the most part you don't see what anybody else is doing. Nobody else can see what you're doing. But in crypto, in DeFi, everything is transparent. Everything is public on blockchain ledgers. So that introduces a different dynamic. So how would HFT work in a world in which you can see what your competition is doing and your competition can see every single trade that you're doing? So the game dynamics are very different. There is also a factor of cost. So for the most part, if you're trading HFT with HFT mechanisms in traditional markets, you know what your cost is. It's infrastructure. You pay some fees to exchanges, but it's very predictable. In DeFi, you have the cost of transactions. So you have gas fees and things like that vary according to market conditions, according to network usage. So it's something that you need to evaluate because you can execute perfectly viable trades, but then the cost of execution in the form of gas, Ethereum blockchain could be too expensive, and then the trades become invaluable. Then there is this new concept of miner extractable value that ultimately you're at the mercy of the order in which miners place transactions in a given block. So there is some mining companies, arguably unethical, are one of the biggest front runners of DeFi trades in the market, and that's why projects like Flashbot, like Archer DAO, are trying to mitigate that with providing mechanisms by which you can compensate miners based on the transaction that they're processing, and based on that compensation, based on this incentive, they can place the transactions in a block accordingly. Because if not, you can have again a perfect trade, but then the miner places it in the front order, or they front run the transaction, and then the trade becomes unviable. So the way that you should think about a comparison between traditional finance and DeFi when it comes to HFT, given an opportunity in traditional HFT, you have different algorithms that they try to be faster than anybody else, and they execute it solely based on speed. But when it comes to DeFi, you have other factors, right? You have block time, you have cost, you have MEV, you have the transparency, gaming dynamics, you have many other things that you need to evaluate in order to formulate correct HFT strategies. So a very simple comparison between traditional HFT and DeFi HFT. In traditional HFT, the information is sort of imperfect, so you don't see what your competition is doing. Your competition doesn't see what you're doing. In DeFi HFT, it's a perfect information game. You can see all the trades. If you want to front run a transaction, you can. Some other people are going to try to front run your transaction. The cost in traditional market for HFT strategies is nearly fixed, whether in DeFi HFT is completely variable. The speed of execution is measured in nanoseconds. Here it is in DeFi is limited by block time. And for the most part, the traditional infrastructure in HFT, in traditional HFT is very well known. Whether in DeFi, you're always vulnerable to the minor criteria for placing transactions on a given block. So infrastructure, a second takeaway from this session. The first one is that DeFi HFT is not about speed anymore. The second takeaway is that infrastructure in DeFi HFT always beats strategy. So infrastructure is key. Having a good infrastructure to execute trades, to discover strategies, to monitor mempools, to analyze the cost of execution, things like that. In the long run, it's better to have a great trading strategies. So when you're thinking about DeFi HFT, a lot of these concepts are intuitive, but there are really not many people implementing this type of solution at a scale. And so there is not a whole lot of documentation or best practices or things that you can follow. So I would like to show you some of the best practices that we have learned the hard way from doing this stuff. So some of the key building blocks that you need to use when thinking about HFT strategies in DeFi. One of them is monitoring mempools. It's very intuitive, right? So many transactions, many strategies are based on identifying, let's say, imbalances in automatic market makers or mispriced or arbitrage opportunities with DeFi indices, and you can monitor those in mempools before the transactions get processed and try to forecast the state of the blockchain, right? The state of a specific AMM after that transaction gets mined. So having good mechanisms for monitoring mempool is essential to DeFi HFT strategies. Also, the idea of every transaction in DeFi costs money. So in the case of Ethereum, strategies that execute in Ethereum DeFi protocols, we're talking about gas. Gas gets expensive or cheaper throughout the day. So having mechanisms to accumulate gas when it's cheap, to spend it in bidding wars when it's more expensive is key. We typically use fee tokens, that is a tokenized mechanism for gas, and typically we use heuristic algorithms to estimate when the cost gas is cheaper, as you can see with this heat map on a specific hours during the day. Purchase it these days and use it in bidding trades when it's more expensive. Then the idea that you can, when you place a transaction in DeFi HFT protocols, you need to look out for front runners. It's always going to happen. So their bots are the only thing that they're looking for is trying to front run a specific transaction. If you're trading passively in Uniswap or Balancer and all that, you're getting front run for the most part. So having a good mechanism to monitor the mempool, identify front runners, and then try to enter in a bidding war and try to bid out those transactions is important. For the most part, once you bid multiple times, front runners get out of the way, and you can execute. Then the idea that you can to avoid this concept of front running mechanism, what I mentioned, there are projects like Flashbot, like Archer DAO, that are providing integration with mining pools directly. So you can essentially assign a price to the transaction, how much are you willing to pay, and the miners will use that. So Flashbots in particular have getting a lot of attention recently. So being able to integrate with this type of protocols to route directly to mining pools is sort of an interesting idea, a good building block to have in DeFi HFT strategies. Then there is also the idea of obfuscating the input of transactions. If front runners are going to be trying to understand what you're doing and trying to front run the transactions, you can sort of obfuscate the input, so it takes a little bit harder, much of an effort to understand, to try to understand what your trade is trying to do. And then on that note, even if transactions are obfuscated, you can use this mechanism of replaying the transactions of chain. So there are clients like Open Ethereum that allow you to do that. You can replay the transactions of chain, forecast the state of the blockchain a few milliseconds before the transaction gets processed, understand how the blockchain is going to look like, and proceed to do a trade. So there are other relevant building blocks of DeFi HFT strategies. So things like understanding maybe price prediction models based on signals on centralized exchanges, integration with multiple protocols is key. There's some emerging set of strategies that are arbitraging between different blockchains and things like that, like Ethereum and Polygon is a very common type of arbitrage these days. So there are some interesting ideas in that sense, but the building blocks that I mentioned are probably some of the key. So I would like to show you like 2 or 3 basic strategies, so you get an idea how does HFT in DeFi looks like. So for instance, an interesting strategy that we have put in place and have been relatively successful is this idea of arbitraging AMM balances. So think about transactions in protocols like Uniswap or Balancer that can cause an imbalance in a pool. Typically, there are bots that will try to arbitrage that transaction in that pool, but what is even more interesting is that if you can arbitrage across many AMMs. So a traditional strategy here is you monitor the mempool, you identify transactions that could cause an arbitrage, you calculate the best path of executing across Uniswap, Balancer, SushiSwap, and others to maximize that profit, place a transaction, then you need to monitor the mempool for front runners that will try and start in that bidding war and ultimately try to process to get your transaction executed. This works very well with UniB2, with Balancer, with SushiSwap. With protocols like UniB3, then liquidity mining has moved from being a passive mechanism to an active market making mechanism. So there are strategies in UniB3 for HFT in which you're supplying liquidity literally block by block. So you can look at the mempool, identify where those transactions are going to land, and try to provide liquidity within those ranges in Uniswap P3, and do that every block. So you can be moving literally hundreds of millions every single block, which is a very interesting type of HFT strategy. Another type of strategies that we have seen being very successful is arbitraging DeFi indices. This is a classic one. In traditional markets, there are many strategies that arbitrage ETF or indices mispriced. In DeFi, indices are very inefficient. So you can monitor mempools. I see some transactions that will cause an index like DeFi Pulse and others to be mispriced, and buy and sell on both ends. So buying an AMM and sell the index, or the other way around. And it's a strategy that, for the most part, works. It takes a little bit of work, but there are many variations of it that have been quite successful. So to close out, and I know I'm going like 1,000 miles per hour, but to close out, I would like to leave you with 2 futuristic ideas about the future of HFT and DeFi. One of them, and I published an article in CoinDesk about this thesis, is this idea of automatic strategy learning. So today we're designing strategies one by one, but there are techniques such as reinforcement learning and things like that in machine learning that, if you, given the state of the blockchain, it can learn from every single trade and formulate trades on the fly. This is quite interesting. Another idea that we're very intrigued by is this concept of tokenized HFT strategies. So today we have protocols like Y-Earn, like Convex, that are tokenizing passive strategies, so supplying liquidity and things like that. So why not tokenize active strategies and place trades block by block? And you can put money into a pool, receive a token, and that protocol will actually trade different HFT strategies and return the profits in the form of tokens. So quick summary, and I know I went really fast, but I really wanted to provide all this content as part of this session. DeFi represents a new playground for HFT. It's the first technology movement that sort of challenges the fundamentals of HFT. Infrastructure is key to execute HFT strategies in DeFi, and HFT is a feature, not a bug in DeFi. Right? Many protocols like Uniswap, like Balancer, include arbitrage as a key building block, so it's part of the infrastructure. So as DeFi continues to evolve, HFT is going to continue to evolve in DeFi for the foreseeable future. That's all I wanted to cover. I would like to thank you very much. You can contact me directly at jr@intotheblog.com or through my Medium blog. I tend to be very active on Medium, and I'm relatively responsive via email. So with that, I would like to, there are a few questions in the Q&A panel.
Hi, Jesus. Unfortunately, there's not enough time for the questions, so they will either have to contact you directly, or you will be in the lobby and they can contact you there. So there's different ways to contact Jesus. So hopefully you're going to stick around and interact with the attendees here at the conference today.
Perfect. Well, thank you very much for having me, and I hope you enjoy the content.
Thank you so much, Jesus. Good afternoon, everyone. And, so, continuing with the agenda, of course, we have our third keynote speaker, Mr. Shahzaib Jaffer, co-founder of Dema. Shahzaib is a fifth-generation Tanzanian entrepreneur with business interests in a diverse range of sectors from hospitality, entertainment, real estate development, health, and technology. Shahzaib has completed his BSc degree in technology, digital business, and entrepreneurship at Cass Business School in London. Welcome.
Thank you. Let me just share my screen. I'm very happy to be here and very honored as well.
Perfect. Enjoy the presentation, guys.
So today my focus will be blockchain and its application in developing contexts. In specific, I'll be talking about blockchain in East Africa, which is where I'm from, and so as to not generalize all developing contexts under one umbrella. So to begin, I want to comment on the rate of innovation in the world we live in today. So to start, the most famous innovative metric is Moore's law, which states that the number of transistors on a microchip doubles every year, while the cost of computing is halved. In 1981, a gigabyte drive cost about $500,000, and an Intel processor running at 60 MHz cost $360. In 2018, a gigabyte cost less than 2 cents, and a 3 GHz processor cost roughly $3,000. So in constant dollars, the price of processing has dropped some 500-fold, and the price of a hard drive has dropped 250,000 times. Now, as a corollary to Moore's law, there is also Bell's law, which says that every decade, a 100-fold drop in the price of processing power engenders a new computer architecture. However, in the time we live in today, we can see that despite Bell's law, we have indeed outpaced it, because in the space of 3 decades, we've had a 500-fold drop in the price of processing. Even to quote Joe Biden in his most recent speech a few weeks ago, in the next 10 years, we will be seeing more change than the change we've seen in the past 50 years. And to put that into context in terms of blockchain, by 2020-25, 80% of all fintech should be blockchain-based. However, I find that today, most of our interaction with blockchain outside of Bitcoin and trading is kind of sparse. But insofar, about 2,112 blockchain patents have been filed in the US, and half of all blockchain patents filed are in fintech. I think also, before I dive into my product, Demo, and what it does, it's important to also define blockchain for those newcomers who may not understand what is blockchain and how it works. So to put it in a nutshell, blockchain is governed by 5 principles. The first is distributed decentralized databases, which means that there are no gatekeepers. Databases are distributed and not centralized, and hence are not vulnerable to any attacks, and nor are there any authority nodes who can inhibit the ability to transact within this context. The second one is peer-to-peer transmissions, which results in the bypassing of authority nodes. The third one is computational logic, which requires proof of work, proof of solvency, which ultimately gives rise to the ability for smart contracts to function. The fourth is transparency with pseudonymity, the ability to transact without revealing your own identity, but at the same time, maintaining transparency. And the fifth, of course, is immutability. And to phrase it in a maxim, I would say the internet gave rise to the age of information or misinformation, whereas blockchain, on the other hand, etches its information in digital stone. If we were to also contextualize blockchain today in regards to how it looks in terms of the technology S-curve, I would say that we are still in the era of ferment and not in the era of incremental change. And the era of ferment is usually defined by a large variety of multiple projects, multiple different applications, and multiple different creativity and innovative ways to apply a technology. Moreover, the dichotomy between an era of ferment and the era of incremental change is marked by the emergence of a dominant design. And so clearly, with the amount of blockchain projects around the world that have been accelerating, the amount of patents that are filed, we're still in the era of ferment, where we're still trying to get it right and still trying to learn how to scale up blockchain initiatives and blockchain solutions in a way that is also not detrimental to the system. In regards to also Bitcoin, usually with Bitcoin, the higher the amount of transactions, the higher participation rates, the ecosystem of the blockchain is compromised because it becomes harder to host. However, today also, in terms of Bitcoin, can only handle a few transactions per second, whereas many other blockchain systems today can handle 5,000 to 6,000 or 7,000 transactions per second. Now, into my product, Demo. Demo stands for Digital Money. It's a product that I founded in 2018 with my older brother while I was in university. And mobile money in East Africa represents a very large industry of technology that has been quite silent, nascent, and I would say embryonic as well. As of now, 54% of all mobile money transactions in sub-Saharan Africa are focused in East Africa. So just to contextualize this, here's some general statistics. So the number of registered mobile money accounts in Uganda between 2009 and 2020 has been increasing at an exponential rate. As of 2020, there were 30,374,502 registered mobile money accounts. In regards to the amount of mobile money transactions per year in Uganda, as of 2020, it hit 2.5 billion, which is a serious increase from 2 million in 2009. Again, over here, we see that the growth rate of mobile money adoption is also exponential. In regards to the mobile money transaction value per year in Uganda, we can also see that it hit an all-time high in 2019 of 19 billion, whereas in 2020 it settled at 17 billion, which resulted in an average of about 1.3 billion US per month. Now, in regards to technological adoption, innovation, and as well as the presence of digital infrastructure that can host either financial industries or host supply chains and so on and so forth, mobile money presents a very unique happening that has occurred in East Africa. It was founded in 2007 by Safaricom in Kenya. However, within a space of 14 years, the rate of adoption has been astonishing and also phenomenal. However, despite this a higher rate of adoption and despite this increasing amount of money that is present in this industry, there's been a severe lack of innovation and a severe lack of interoperability and adoption in regards to the people at the bottom of the pyramid. Indeed, in the past few years, the dynamic of the mobile money industry has been marred by high fees that is in an oligopolistic market dominated by large mobile network operators. And just in the past few months, transaction levies in Tanzania, in Kenya, and in Uganda have resulted in significant drops in mobile money adoption and mobile money usage. So to put that into context, the average mobile money user in Uganda is moving about $7 a month at a frequency of 7 times a month. The equivalent Ugandan shilling value is associated with a fee of 0.660 cents, and thus a 9% cost of users on their entire transaction value. This fee cost of 0.630 multiplied by 7 times a month means that the average mobile money user for MTN, which holds a 45% market share in mobile money in Uganda, is paying $4.41 in fees per month. Now, this is quite high when you take into consideration that 38% of the entire population of Uganda is living under $1 a day. Moreover, the ability for a Ugandan individual, a Ugandan person, to transact digitally results in benefits and increase in productivity that are so much higher in proportion to the fees that are being adopted. So my company, Dema, is a blockchain-based mobile money solution. We're the first blockchain project in Africa to have ever received a patent from a central bank, which was awarded in 2019 from the Bank of Uganda. It was also presented at the World Economic Forum in Davos in 2020. So unlike current mobile money systems and regimes that are existing in Kenya and Uganda and Tanzania, we do not charge fees. So usually in Tanzania or Uganda or Kenya, if you were to transact with mobile money, there would be a fee associated with every single transaction. Hence, in economic terms, the marginal cost versus the marginal benefit must always be considered every time an individual decides to transact using mobile money. Unlike this, Demo charges only $1 per month for unlimited transactions, and even for those individuals who cannot afford $1 a month, Demo gives them 10 free transactions monthly. And then upon the 11th transaction, a subscription fee model kicks in, and it's only $1 per month. Moreover, we also leverage the use of blockchain in terms of its high security. I think about 14% of Ugandan individuals report that they don't like to use bank accounts and they don't like to use mobile money due to the safety issues associated with it and lack of trust. In 2018, in Tanzania, there was a $3 million hack of mobile money. In Uganda as well, the amount of banked individuals was 13% in 2009. In 2019, it was dropped down to 9%. So we're seeing that the adoption of conventional financial services has actually decreased over a decade span, whereas mobile money has indeed increased. But despite this increase, we're still marred and faced with high fees and also extortion from these large oligopolistic markets. In addition to this, government also involvement in regulation of mobile money has resulted in higher fees. If you also look at the amount of contribution that mobile money pays in Tanzania to tax revenue, it is bigger than that of cigarettes and alcohol combined. Our project also aims to give benefits that go beyond just the ability to provide infrastructure to transact digitally, but also provide tools that allow users to take advantage of this in terms of economic terms. So for example, in Tanzania or in Uganda or Kenya, if one were to use mobile money as a business, there is no demarcation between a business account for mobile money and a user account for mobile money. They're both one and the same. If a business at the end of the day wanted to tally up all their mobile money transactions and receipts, they'd have to individually scroll through all their transactions on text message. And then they'd have to then physically write down or then digitally convert it. Whereas with our product, we give it straight a business account, which allows for bank statements and financial statements to be emailed to the accounting sector. In this way, also, we allow for businesses to take advantage of data analytics to show what is the traffic of mobile money, what is the average spend per person. And we give the opportunity for businesses, and especially SMSEs, to take advantage of mobile money tools and not just mobile money infrastructure. Another factor that we've included within our project is the ability to peer-to-peer lending, which is tied into decentralized financing. Because of the blockchain system and the lack of authority nodes, we have created a system whereby users can transact with each other and even lend to each other without the need for this to be audited or approved by a third party or a central bank or a central figure. Okay. So I've spoken about my product and I've given you a small rundown of the mobile money industry in East Africa. But what is the wider implication of this? There are thousands of interesting projects every year being inputted and created, and there are many more interesting projects than my project. Mine's quite simple. It's just taking an existing industry and putting it on a better system so that we save cost. And as a result, we charge lower prices and increase financial inclusion. But what is the overarching implication of a business model that takes technology and that takes an existing incumbent industry and combines the two to create social impact, particularly through financial inclusion? Having studied economics at many institutions in my whole life, from Cambridge University to Harvard University to even Cass Business School in London, I've understood that every technological innovation, every industrial revolution, from the steam engine to the internet to steel and line factories to electricity, not only engenders a new architecture of technology, but also engenders a new architecture of economy. New technology creates opportunities for entrepreneurs to take advantage of decreasing costs, increasing returns to scale, to provide higher access to services. To quote Harvard biologist David Sinclair, he described the process of tool building from the time the first human picked up a stick as a treadmill. And this is a treadmill we can never get off. And the pace at which this treadmill increases yearly is so much faster than the previous year. Indeed, now even with Bell's law and Moore's law, we're going to surpass the exponential increase that is defined every year, especially with the advent of quantum computing. Indeed, people say that our processing speed will increase 100-fold per year. So, to conclude, in terms of the dynamism between adoption and innovation yields the following conclusion, especially in the mobile money industry in East Africa. When adoption outpaces innovation, price increases. And when the marginal cost participation increases disproportionately relative to the marginal benefit of that innovation, disruption occurs. And this disruption is clearly shown through my project Dema. I also want to take some time to focus on mobile money and its impact. It is often the case that technological innovations have been confined and exclusively enjoyed by upper-class aristocratic classes and big business and big industry. However, mobile money in East Africa has taken a more unique approach to how it's helped people at the bottom of the pyramid. So to exemplify, Bidi settlement in Uganda is a refugee camp in northwestern Uganda. It has over 270,000 Sudanese refugees. In 2017, it was the largest refugee settlement in the world. But however, a digital money infrastructure in the refugee camp affords displaced people with the ability to manage their finances, to pay for necessities, to borrow money, and to also send money to other refugees living in other refugee camps. So in Bidi, 44% of refugees use mobile money, and 80% of the population live within 1 kilometer of a mobile money agent. Now, when I first read this many months ago, I was quite shocked that despite the clear link between mobile money and its effect on people at the bottom of the pyramid, and here we're talking about refugees, we're talking about people who are literally at the bottom of the bottom. They facilitate and occupy a space in economic terms that is so small that even their contribution to economy is negligible compared to the top 1%, compared to the bottom 90%. And I was hit with an interesting quote from Angela Arendt, the former senior vice president of Apple, who wrote that if you aren't building a social enterprise, I don't know what your business model will be in 5 years. So to further exemplify what kind of impact mobile money can have on households. Globally, half of unbanked adults come from the poorest 40% of households within their economy, making it nearly impossible for them to show a financial history to access financial services. In Uganda, per capita consumption of rural households who use mobile money is 72% higher than rural households who do not use mobile money. In Kenya, households who use mobile money experience a 7% drop in the consumption of goods, services following a negative income shock, while those that use mobile money had no drop in consumption. Another example of how digital infrastructure has helped households is that in Uganda, coffee farmers who use mobile money receive 5% higher prices for the coffee than non-users because they could reach buyers in higher value markets. So, to frame this into perspective, we now are confronted with an industry that, number one, has a lot of money in it. And number two, represents a technological innovation that has created a whole ecosystem,
and these are basically just looking at the tools that make it possible for people to build more innovative DeFi products and get to market quicker. But we also built a bunch of services around that as well. So we have an API-based AML KYC product that allows DeFi developers to include AML KYC into their products so that they can also start to service the institutional market as well. So we spend a lot of time working with DeFi developers building decentralized finance products, basically.
That's awesome. Sergey, what about you?
So hi everyone, my name is Sergey. I'm co-founder of 1inch Network. Back in 2019, I invented together with Anton Bukov, my co-founder, on ETH New York Hackathon in New York City. aggregation among decentralized exchanges to solve a huge problem in DeFi space. What was the distributed liquidity among several exchanges? You never got the best rate, so we just solved this problem by just using algorithms and splitting among DEXs. Right now, we are aggregating more than 65 liquidity sources on Ethereum, 30 on BSC, and about 16 on Polygon, and offer exchanging tokens in a decentralized manner by using aggregation protocol among multiple markets. So it's not just splitting, it's just going through multiple markets, and one single transaction, fully secure and safe for the people. One-inch network itself is not just an aggregation protocol, it's more. It is also limit order protocol, liquidity protocol. Every time when we release something, we solve additional problem in DeFi space. So we are here to grow the space to make it user-friendly for the users. For example, our wallet is also kind of product to onboard new people. So my professional background, more than 15 years of software engineering architecture experience with business experience in aggregation and multiple startups, consulting services, Bosch, Siemens, Porsche, so on.
Awesome, great. And lastly, Aaron Tilton, what about you?
Thank you. I'm CEO of SmartFi, which is an open lending platform. We have both a CFI platform and a DeFi platform, interoperable DEX. And our history really started going on about 5 years ago in an odd way, where we originally are a 14-year-old company developing energy infrastructure. So we used to develop oil and gas pipelines. Also, we develop a new nuclear power plant site. So our background really is in energy, and we're experienced in the derivatives in the energy space. And as we started getting all these strange calls from cryptocurrency miners looking for large-scale power that were sometimes as large as powering a city, and wondered, what are these guys doing with all this power? And that was our introduction into crypto. And so we started helping develop these large-scale sites for mining. And when the market had a big correction in the latter half of 2017, early part of 2018, all the projects that we were working with, the miners said, "Hey, gosh, my crypto, used to be worth $20,000 in Bitcoin, and now it's down to like $3,000." So none of them had any money to keep moving on with their projects. So we decided to start lending them money, and from those beginnings, we started a platform and started lending money to cryptocurrency miners. And so our largest customers were actually in China. We were here in the United States, and from there we started figuring out some of the things that we wanted to innovate in the space. Came up with different algorithms and structures. My background, 20 years ago, I worked for a software hardware company that built ASICs for interactive voice response. So the combination of my background in energy and in hardware led to our beginnings here in crypto, 5 years ago, and all of a sudden we became a cryptocurrency-backed lender and started working in the space.
Exciting. It's a great panel to have here discussing maximizing crypto earnings. So one of the first questions is, there's so much that one can do in terms of using decentralized finance. What are the best ways of maximizing your crypto? How do you get it to start working? Do you go more the traditional route? It seems like we've kind of have two different paths. One that is kind of the lower APY, which is far more secure, and then one that is kind of much more higher APY, which is really kind of almost taking the risk of these newer projects. How do you see yourselves in the space maximizing your crypto?
I mean, it depends what your risk profile is, as you say, but I also think it depends on whether or not you are sort of buying into the decentralized finance dream or not. A lot of what the promise of smart contracts is that you don't have to have a centralized intermediary to hold the security of the underlying money that's being placed with them. So like with a smart contract, I can put USDC in it, and then I can have a set of rules that I can audit that says whether or not that USDC can be used by someone else. So if you take something like Aave, which has over $10 billion worth of assets associated with it, the whole premise is that Aave, I'm not actually giving the money to Aave. I'm putting my money in a smart contract, and there is a market out there that wants to borrow my crypto. So if I've got USDC as stablecoin, and there's a bunch of traders who are trading across Uniswap, and they're trading across 1inch, and they're trading across other DEXs, they have a short-term funding requirement, and they will post collateral in the same smart contract for that, like wrapped Bitcoin or like Ethereum. And so there's real demand. You are doing the traditional thing that financial markets always used to do, which is matching long-term lenders, long-term credit with short-term borrowers. But we're doing it on top of a decentralized finance infrastructure. Now, yes, those smart contracts might get hacked, and yes, there are risks associated with it, but that yield is real. And you can actually audit it. You can say, okay, I can see that this set of traders is paying, 15%, 20% APY, 25% APY to be able to get exposure to go and arbitrage something on Uniswap. But as a lender, I don't care, because I know that my collateral is completely safe. However, even in the space of centralized borrowing, where I can go to something like Celsius or BlockFi, it's a lot less transparent. I don't know who my money is being lent out to, and where the yield's actually coming from, and how trustworthy their balance sheet is, or anything like that. But they have their regs around them. And so, I think that the whole premise of decentralized finance is this disintermediation and this increase of transparency. If you believe in that, then go use decentralized finance properly. If you're just like, oh, I just want to know that if my money disappears, I've got someone I can knock on the door of and say, hey, my money's gone, then yeah, go with one of these centralized providers, because they both provide yield, and their yields are quite close. So some of this is philosophical, and some of this is also just like, how much money do I want to make?
So I would like to add from my side. So I would like just to share my experience. So I'm in DeFi since 2018, let's say. So late 2018. And I was playing around with a couple of products out there, Curve. First days, I was one of the first guys who used that, and also provided my hard-earned money, I would say, to Curve, because I have seen the huge APY, and based on this actions I did in the beginning of this product, I got a really great airdrop. I was really surprised. I still get these tokens here, and this is great. Same with Gitcoin. So I personally we just used Gitcoin together with Anton, and we got really huge amount of money from Gitcoin. And this is new age what we see right now. Kind of times where everyone can build a great product and grow it to a really a huge one. And just to play around with some protocols, it makes sense, to get maybe also from Uniswap I got some airdrop. But I agree also, the people should take care and understand that every smart contract is safe. Not every project is decentralized. So in terms of Aave, I can say that they have admin keys on Polygon. They plan for sure to all hand over to the governance, but also in the governance, there are 5 of 8 multi-sig, which can just decline every proposal. This is also insane. And if you don't get any support from the Aave team, you have no chance to list the token. For example, 1inch token is not listed on Aave because the team is not supporting them. So there are a couple of problems still there, but we are working on DeFi to improve that. That's from my side.
Yeah, I'm going to try and answer Nelson's question a bit more directly, I guess. I think one good point that he really mentioned was, yields are coming down, right? DeFi on the really safe stuff, right? You land on Aave, Compound, whatever, right? So I think what's really beautiful about DeFi that we see this year especially is that just a year ago, we had DeFi Summer 1.0, and that was kickstarted by Compound's liquidity mining, right? And it's come so far since then. Right, so nowadays, sure, you could go on Curve and maybe you could get say a decent 10% yield, which is great by TradFi terms. But just like in TradFi, yields are getting more and more difficult to get because the people coming in are getting more and more sophisticated, right? They know how to get these yields better. So, for example, nowadays we have Uni V3.
Hi everyone. Please welcome to the stage Joshua Sigala. And Joshua Sigala is the co-founder of Vault Toro, which is first real-time Bitcoin gold trading engine on the market. And he has now gone into the DeFi space and is building a decentralized lending platform run by DAO that focus on hard and soft assets as collateral. And he will be speaking with you about that. Thank you so much, Joshua. Enjoy your time.
Thank you very much, Lavinia. That's it's really nice to be here, and thanks to all the.
Because as soon as everybody else figures out what the trade is, everybody gets on the other side of the trade to generate yield. And our experience in the energy markets has taught us a couple of things over the last 20 years. Is that when you have a trade, one, you don't talk about it, you engage in it, and two, once everybody else knows about the trade, the good side of the trade goes away, right? And certainly with yield farming or other strategies around DeFi, they're going to come and they're going to go, and the innovation around those trades are going to need to get more sophisticated, and they will, because wherever there's money, institutions will come. And so maximizing your yield has a lot to do with figuring out what the trade is, and then it's it's kind of a catch-22. If you know what the trade is and you don't say much about it, or you don't promote it, then not many people are going to engage on either side. So going forward with DeFi, what we see is really the maturity of the space has got to be around broadening the base of the trade and engaging in structures that are typical and outside of just trading crypto. If this space doesn't evolve to something else and to engage the broader public and a broader base of structures, and where people start to specialize in certain types of trades because of the need of the broader financial markets, it's always going to be a niche industry. The yields that you were seeing in the beginning of 1,000x, those kind of things, they were great for a small amount of people, but you need to have a mature space. Some of the things that we're doing is focusing on maturing that space. Most trades are not super complicated. They involve the of knowledge and de-risk on one side, and then somebody else taking risk on the other side. That's the basis of a trade. And so we're structuring our products and the DeFi elements of what we're doing to broaden the market and include things that are not considered crypto specific. We're doing some structures around real estate. We're doing some other things around small business equipment, a broader economy application, so that we can help other people attract the capital that they need in regular business and engage crypto, so that on one side of the trade it involves crypto, but the people who are benefit of the lending part of the capital, they have no idea that crypto is involved. That's when you're able to replicate a trade, generate the yield, and it's something that you can repeat and it has longevity. And so that's where we see the future of DeFi, and those yields are in really the traditional spaces, but you lever crypto, and when one side of the trade doesn't know that it's involved, you can keep your edge in your trade.
I was about to add something. I don't know, how everybody sees the crypto space, but if somebody has been around far too long, you probably notice for systems to be stable and to have a reasonable yield, you need to have a reasonable amount of regulation and a reasonable amount of transparency. One of the things that happens in DeFi is all the transactions, as one of the previous speakers was saying, all the transactions are private. So if I know for some reason that one of your wallet addresses, I could go to the graph, deploy a subgraph onto your smart contract address, and I could just replicate your trade. So literally the depth of the market disappears, which is generally not the case in traditional markets in that sense. See, most of the large hedge funds, for example, on Essence Technologies, you don't know what the strategy is. So there will be that arbitrage that will be happening. So unless the market, as Aaron, as you were saying, unless the market widens and all the different assets that are there comes in, and they are accessible to everybody in a reasonable manner, as in like in a more democratized manner, it will still be, DeFi could still remain as a trade for a smaller subset of people getting higher yields. Otherwise, the yield curve will change the shape, and it will be a normal bell curve in that sense.
I'm not sure I agree with what you two have been saying. Like the provision of liquidity on Uniswap isn't something that someone sees the deal and then it goes away. You are providing liquidity to a market that requires facilitation, and every time someone trades across Uniswap or 1inch, they are paying the people who provide the liquidity for providing that liquidity and facilitating the market. That's a very common thing that happens in traditional financial markets, where you have liquidity providers and you have people who are coming to the market to trade between asset pairs. That is a long-term yield. It's not like that's going to disappear. It is something that you are facilitating markets for, and that's essentially what the underpinning of decentralized finance is. You could also talk about that from the point of view of Aave. You can also talk about it from the point of view of Curve or Compound or any of these things. And the point of regulations, and also an interesting one as well. Like I'm not sure why regulation would change or improve necessarily the provision of liquidity via something like Uniswap, or the provision of collateral via something like Aave.
Is it okay if I try to answer you, Piers? Just to make sure that you and I understand. As somebody who has been involved in building this thing for a long time and have worked in traditional markets, so depth of the market is very, very clear, right? And it is not, all blockchains we know don't work in lightning speed. We know Ethereum at whatever speed it works. So in my past, I've actually been part of the Ethereum Swarm team, so I know to a great degree, I've seen how it evolved and what's the speed it has. Given it's the current set of blockchains, given the depth of the market, if somebody were to just queue up the market, I could pretty much say to you that nothing would happen. And that is literally what depth of the market disappearance in one sense is. It's just the denial of the market space you have. In a traditional market, that is much more harder, because the throughput is far higher. As simple as that.
Yeah, true. Like the throughput's a problem on top of Ethereum. I don't disagree. It's why we built Radix, but I'm not sure that. Anyway, doesn't matter. I think the actual question was like, how does someone maximize their earnings in DeFi? Right?
Hey, let me bring part of this question, because we're talking about maximizing the profits, right? The yield, and that's the core piece of what we look at is that correlation. So the correlation currently for DeFi markets is really built around trading crypto.
More than happy to ramble on and just tell him just about anything. And it was at that point we just took a picture, had dinner, and we went our separate ways. And gotta say, James is a great guy, really top class, great hospitality, and part of the reason I really liked him, and gotta say also a really smart guy. Then I went home and kind of continued in my mining operation. I promise you that all this build-up of the intro is leading to something, and you guys are going to love it. It's going to really put a lot of context to DeFi. And by then, the crypto market was really slowing down, and the ICO boom had died out. Lots of people had lost money, and there really wasn't much interest in the cryptocurrency space. I mean, if you think about it, for
COVID stuff, so they're going crazy printing. So they're like, we want to get money from somewhere. We want a tax. We want
for credit in that space. You can maximize yield when the crypto markets might not be yielding much. That's how I think in the future of DeFi is you maximize yield by getting diversified and finding new trades.
And in terms of companies, projects, protocols that are facilitating maximizing your crypto earnings, we had Sergey talk about Curve. Curve, I think, is a great example of really a protocol that has been able to do that on a big and consistent basis. What other or even
algorithmic stablecoins? What they try to do at a pure level is try to bring down the volatility of crypto by pegging it to a currency like a fiat currency without any backing, without any one-to-one, in the bank, I promise to always pay $1 for your ERC20 sort of backing.
And stuff. And I think DeFi started off as more or less, I think it's safe to say it was kind of like grassroots kind of retail kind of movement, right? It's like driven by retail money, as it grew and stuff. And now it's getting into the limelight, you have like institutions coming on and all that with, Aave is having its permission pools and things like that, right? So, in my opinion, right, for DeFi to go into the next level of growth, obviously it has to grow up a little bit. And, those protocols that are sort of heading in that direction or inclined in that direction, in my opinion, have much better, a road ahead of them, right? So for example, you look at stuff like insurance, right? This is something that when you talk about DeFi,
new things to explore, and it kept me really busy. Honestly, I felt like a kid in the toy store, and it was great to see that energy come back into crypto. So this continued for months and months, and once I felt like a sort of a regular in the space, and I got my way around the DEXs and the farming protocols and stuff, I turned my head to curate, and I was like, hey, this has got to be a golden opportunity. We got to capitalize on this. I mean, this could be big. And I immediately...
What would I like to bring out in that part about innovating and kind of what helps to add maturity to the market space or DeFi is the principle of correlation. And if I'm a large corporation or I've got an insurance company or whatever asset class I'm in or commodities or whatever the real world product is, the first thing I always do to establish can I operate in this space is I look for what is my correlation to safety or to eliminate risk, right? Because the first part is people are not going into this and saying, hey, I'm going to put everything on 21 and spin the roulette wheel, right? When you've got billions of dollars at risk, the first thing you do is figure out how do I get to safety if it all goes wrong? And currently in cryptocurrency, there is no natural hedge, there's no correlation, right? So these assets, when you create a new cryptocurrency, the first thing you should be starting with is actually safety. All cryptocurrencies are emitted on the other side. They come out as risk. So
to crypto. So the DeFi space really starts. So even if there is a huge, ridiculous regulation that just bans everything, like let's say the ECB wants to no, we're going to create our own euro crypto and it's fully controlled and we can turn off anyone at any time. Well, the fact of the matter is DeFi doesn't care because they can't stop it. It's in the cloud.
Is one that I think, these are really high risk, so I'm not recommending these to anyone whose risk tolerance is not super high, but Harvest Finance is really interesting. It allows you to, it has its own Uniswap v3 liquidity provision rule sets, and so it gets around this complexity of having to do between boundaries. Alpha Homura was also really interesting. They have a programmatic way of allocating capital between different yield opportunities that are available in the space. And I think this is going to increase. You're going to see more sophisticated, essentially almost fund management-like instruments that have a set of simple algorithms that then will allocate your capital within the DeFi space. I also think that we're going to see probably in the next 6 to 9 months, there's going to be more decentralized derivatives. So you're going to see things like Potion.finance and
clients, we want to tokenize it. Everyone keeps talking about tokenizing. I'm like, you can't. If you do, you're scamming them. Why? Because if I hold a bunch of your tokens and I die or I lose my private keys, then you are paying, the vaulting facility pays for the storage facility for forever because I've lost the tokens and you have to
the fence and there's yield to be gotten. It will definitely attract other assets into crypto. There's enough of assets to actually have derivatives and other things. And derivatives essentially means you can have secondary derivatives, and that's a scheme that is risky, but that's generally how very large markets are built.
Great. And we just have one audience question, and then I think we can wrap it up. An audience member asked, do the speakers think the wallet segment will catch up? Is there a reason why it hasn't yet?
Can I give it a
seconds? You'd be there for 32,000 years. So the number trillion is thrown around like crazy, but people can't grasp how big this number is. So compared to 11 days to 32,000 years, there's a difference. So hard asset, because
you've seen many technology, but with no understanding needed to build upon it. But you could benefit from the entire ecosystem. And with this mindset and the resources we now had available due to the strong positioning we had established using my little venture into DeFi, I set out to solve all.
So Luigi, I'm going to topic and maybe to just kick off with sharing one or two thoughts around that while we wait for the other panelists.
Sure. Thank you, Richard. Yeah, so my background is from traditional finance. I worked at Citigroup for about 7 years, trading various products, credit derivatives, and equities. Also did some M&A consulting after that, but really got involved in crypto in a big way in 2017 and 2018 when I raised funding for a DApp that I was building. So that DApp was to solve misinformation online.
We saw a huge effort. For sure, they have paid a lot in the beginning. They paid a lot for Infura, free service, also MetaMask itself. And I see a good opportunity that they would improve MetaMask a lot in the next time. I wish it because it's terrible to use still. And also on our...
I didn't go and buy a pen and paper. She bought herself an iPad and an Apple Pencil. I mean, it's only the natural next step that we got to have a platform for her to sell her beautiful work on, or for these millions of artists. And that's when the opportunity now became clear. And I started to realize that this new generation that I like to call modern day street artists now would have a platform to sell their work and build a reputation. A modern problem.
Niches and that are going to transport different layers of value. So we saw recently what happened with Polygon, where they were able to, attract a lot of users, TVL, over to their ecosystem because it's faster, right? Because it's has more of an ability and cheaper gas fees. So I think you saw them come out. You saw BSC, Avalanche. Obviously, we are EVM compatible chain
in the space, so that everybody doesn't need to be a blockchain developer, but can solely build on top of this technology to add value to the consumers' lives. Decentralization is the next step, particularly in today's society where mistrust among centralized bodies is common and big companies misusing our information. And what's funny is we let them do it because we're so reliant on them, and honestly, we just don't have a better alternative. But knowing about blockchain and being...
I first came across Ethereum and fell in love with it, and it's been like my one huge focus.
I'm sorry if I pronounced your name wrong, man. Tether Limited has never substantiated their claim of full backing through a promise audit of their crypto reserves. Seems like we can't trust.
Bond issuing tokens in the form of NFTs could be solved. Now, how you may ask on that is very few know that NFTs can be embedded with a value. Coupling that with smart contracts, you could have an NFT with a set USDT value that releases in a couple of years, fully verifiable. So we know we can trust our government. NFTs is like the art market. And
there could be certain niches that all settle and kind of interlap on Ethereum, but it really depends on how Ethereum 2.0 looks, how it acts. I think that's still a bit of an unknown. So it remains
years and still providing value, which I think inevitably will somehow flow back to Ethereum. I still think Ethereum will be the kind of settlement layer, the basic hub, and everything will kind of connect to it, just like you have Polygon, you have Arbitrum, Optimism. There's going and the whole NFT infrastructure on top of it. Ethereum is already kind of a self-sufficient, and it's up to other projects to come and connect into it and to keep providing value to it. So that's kind of my view.
I think you make a very valid point. Market adoption would be critical with anything like this. And once someone's trusted and used something for a period of years, it's very difficult to switch over. And even if you do switch over, you might just switch over to test it out, try it out. And it really would have to be something special. But while you're switching over, of course, you would have to have a lot of people taking that same type of action before it could, pose any type of threat. As humans, that's just what we do. When we find something that works, we improve it and we bolster it and we make it better and better. And it's really difficult. So first mover advantage, I think, is something that is critical. Once you've got market dominance, it is really, really difficult, especially with a complex type technology like what we're dealing with. You don't just overthrow it. So I certainly think that for the next couple of years, we can expect to see some great things coming with Ethereum and
ecosystem with none of the complexities. And I'm proud to tell you that this is what we're building here at Curate, that ultimate bridge between the traditional.
Oh, she's the thing.
Hey, Lavinia. Hey, Theo.
Sure. Yes. So, thank you so much. I'm assuming that you've answered your questions.
I have.
Thank you so much. I'm assuming that you've answered your questions.
I have. There's been some really good questions and intelligent ones too, which is always wonderful to see.
Well, it's a great subject and it's a very important subject because stable coins are obviously a real key part of DeFi and NFTs in regard to retaining the value. So I'm sure it was a great talk. Thank you so much.
We're still in stealth mode. We're building, but if
conversation look back upon, we're going to be like, guys, you don't even know what you started. You don't know how early you were. You don't know what type of pioneers you were. The things that are going to come out are going to absolutely blow our mind and change every single factor of our lives, change everything. As humans, we are just becoming more and more complex creatures. And I think that there is literally, and I say this not figuratively, there is literally no limit to what we can do. And, you've got to start building from the bottom, and that's where we are now. So very, very, very exciting times.
Yeah, and the beauty of it is that's why having dozens of different new blockchains approach it from their angle is, I think, fuel to the fire, and we're just innovating faster and faster. If it was just one Ethereum and one Bitcoin and nothing else, that would slow down innovation by 1/10, even worse, right? That's the beauty of having so much, and the beauty of the whole permissionless, decentralized idea that lets it happen. So maybe it won't even be 20 years. Maybe it will be sooner, that vision that you mentioned. That'd be really cool.
The other thing is what's cool about this space is, Ethereum and even the first movers, much different than, in the traditional world, have the advantage of kind of pulling the pieces that they want from other layer ones, right? So they'll be able to look at Avalanche's consensus, be like, oh, maybe we want that piece, or we'll look at the tokenomics, maybe we want that piece. And, they can maybe use that to their advantage as well and not have to develop everything in-house. So that's what's neat about this space. And that's why I don't like the word competitor, so to speak, because I think we're all iterating to kind of get to the place that we want to be. And, however it happens, it happens. But, I think that's going to be an interesting point too moving forward.
Absolutely, Luigi. I agree with you. You know, you've once again said that there's no competition. I think that what we are starting to see now is, you know, collaboration like we've never seen before as a species. The wisdom of the crowd, because exactly what you've pointed out, you know, someone can develop something, someone can have an amazing idea, and that idea can be transferred with very little effort or thought power onto another project. And it is a collective that builds these dynamic projects. So, you know, Ethereum definitely looking like a very, very solid foundation, and it will be for many years. And we will just continually build on that. So where do you think that's going to lead DeFi? Is Ethereum going to constantly improve and keep its stake, or is it going to be watered down dramatically? I mean, that, I guess, is the question of the panel this afternoon.
Well, one thing that I think is really interesting that we haven't touched on yet is governance. And, you know, where governance sits is actually really important. So right now, a lot of the governance of the largest dApps in DeFi and large DeFi protocols sit on Ethereum, right? So whether or not they scale to other chains, still value accrues to Ethereum, which is, you know, kind of the beauty behind of what's happening here, right? So I think, you know, if any other chain is to supplant Ethereum in the future, the only true way to do that is to have faster innovation, better projects where the governance sits on that chain. You know, that's not to say that another chain can't grow as fast or with Ethereum, but I'm saying if one is to actually like remove Ethereum from being that settlement layer, from being that governance layer, it's an innovation question from my perspective.
Yeah, okay. I think it's great that you mentioned governance as well, because sometimes what it comes down to is incentive mechanisms. Like, that's the beauty of the blockchain. For now, you can program incentive mechanisms like we've never been able to do in the financial system for the last 200 years because it was centralized. Now build a better incentive mechanism and all the users migrate to you, right? So that's one thing that we're kind of exploring now to see which of these other ones has viable and kind of positive incentive mechanisms through the use of tokens, through the use of whatever mechanism they use to capture that value.
Yeah, I mean, from a bootstrapping perspective, it's something like we've never seen before. I mean, you know, you think about how hard this was for like Airbnb when they were, you know, making Obama posters in their like apartment to try and get people to use Airbnb, you know, or cereal boxes they were using. You know, this is totally different. You're able to airdrop tokens, like the Uniswap sushi example is the best, right? You know, you fork a protocol, both of them are still alive today. And, you know, I think that's really fascinating from my perspective, because now they're kind of going in different directions, or, you know, they have different innovations, but that's what's beautiful about the space. The users will decide what's best, but we still get more choices. And from my perspective, more choices is usually a good thing when it comes to innovation. So, you know, I think you're going to see the same with layer ones, the same with DeFi trading protocols, and, you know, the same with other things that in 2017 and 16 that we wanted to see happen that still haven't, like decentralized Uber, Airbnb. I think those things are still going to happen now that the infrastructure is being laid.
Absolutely, yeah. It's you know, I think that certainly is the way that we need to look at things. There's something else that also interests me, and, you know, it's just really fascinating to see it from a human perspective, and that is tribalism. You know, when people just gravitate to a project for no logical reason, and, you know, like Bitcoin maximalists, you might get Ethereum maximalists, or you might get people that are in the Cardano camp, and they cannot, you know, embrace multiple projects. Do you think that that's going to play a role in either keeping Ethereum as the de facto choice, or actually not, and, you know, getting people to look at other things and becoming tribal towards the other projects?
I think there's always going to be a segment that's like 90% speculative, and they probably couldn't care less about the underlying technology. They've just jumped onto that bandwagon. It's been maybe profitable, which has validated their kind of choices, and then they just go along, and they do commit their time and more time into this. So it's normal for them to feel really attached to that and to try and defend it, especially when they look behind it. There's like 5,000 more tokens all vying for attention, and like not all of them can win. That's kind of like why I think we get those dynamics. But I mean, yeah, even in the Ethereum space, you see that as well. But then there's other many open-minded people and like that are working on the fundamental layer that really couldn't care less about that.
Yeah, the other thing with that is, right, I mean, from a lot of the people that I met with and have talked to in the space, if you hear about their stories, there's a good amount of them that had a similar progression, right? They were Bitcoin maximalists, they became Ethereum maximalists, they became blockchain maximalists. So like they iterated over time, and that's not to say that that's everybody, right? There's obviously people who are still Bitcoin maximalists, but I think for this space to open up, past where we exist today, that crowd is less tribalistic in general. So what I'm saying is like the continued growth of crypto is going to dilute a lot of the maximalism over time, is my guess.
Very good point. I mean, I've always personally, if someone said to me, do you like this or that? Which one do you choose? My general answer is normally both, and I'm certainly, I personally believe that any type of maximalism thinking really hampers innovation and productivity. And, it goes along with the culture of open source software and just how we've all transitioned. And I think that is a very, positive way, a positive sort of psyche for us to move in. And that is going to be a way that we constantly grapple with the best technology. So, for that reason, I think that Ethereum will really have to be something that people will continue to use. Not that people are tribalistic towards, but because it has got that market adoption and it is the de facto choice, and it's going to continue to be that choice until something can actually overtake it. And even as you say, Luigi, and you've said a couple of times, it's not going to compete. It could complement, it could create a different niche for Ethereum. So I certainly very, very bullish on Ethereum in the near future and in the midterm future. I think that we're going to have to watch the space to constantly know which way to move, and you have to constantly be immersed in this technology. And obviously, when you are passionate about it, it's not a task or a chore. It's something that just comes naturally.
Yeah. The other thing with that, just real quick, I just want to piggyback off that point real quick. What's interesting about that is for the future, first mover advantage only gets you so much, right? It's about the team that iterates, right? Like Ethereum is going to have to, it's impossible to say today that Ethereum will continue to be the chain, because the decisions that they make going forward are very important to determine whether or not they'll continue to exist around the world. I mean, there's been many examples of first mover advantages that have failed, MySpace being the most glorious. But, I just think that it's about the team you invest in. Right, the team that's building that project, the culture around it, the ecosystem around it. So if that continues in the trajectory it's going, then yes, it'll be hard for anybody to kind of take over Ethereum.
And just to add, I think there's actually less antagonism between Ethereum and maybe Avalanche, Ethereum and Terra. Like many DeFi focused projects, the conversations are pretty respectable, and there's no hostile feelings. It seems to be more like, let's say, the Bitcoin crowd against Ethereum or maybe Cardano and Ethereum. But I mean, these are probably the exception rather than the rule.
Yeah, for a lot of projects, I could speak from my experience that we talk to. Some are multi-chain, or they're taking a multi-chain approach. Some are, considering on the fence. And then there are other that are going native to other chains with that governance aspect that I spoke to before, right? Because if you do have faster speed and scalability, then, it does help the governance layer as well. So yeah, to that point, we don't really have conversations where it's an Ethereum or Avalanche conversation. It's hey, look, we both have technology out there, leverage the ecosystems, ours, which is organically growing quite quickly. And, kind of see where the chips fall.
So going back to governance, but in a very roundabout fashion, and talking about the team behind, say, for example, a project like Ethereum, do you think we ever get to the point where that team is the community, where it is driven? And I know that's what we're constantly trying to do by the very nature of decentralization. But do you think that it's effective, or do you think that team needs to, at this stage, still be strong enough to keep that project going?
I mean, I would say from my perspective, the team needs to be strong initially. Decentralization works when it builds off of a strong foundation, but to start with decentralization is usually quite chaotic. I guess it depends on the nature, but teams. What's interesting is in crypto, a lot of times the communities look to the teams, right, when it's early on, to build the innovations, to figure out things, and And sometimes it's a matter of who knows the product best, and usually the one who built it knows it best. So
yeah, and I think it's a process, almost like a journey where you go through different stages. And I think at first you did need like kind of close control coordination just to make sure at a technical level you don't have any weaknesses. But over time, as it matures and everything, I think it, like Bitcoin starts to ossify, and it gets harder to make any kind of suggestions, any kind of changes to the system. And at that stage, it is like pretty much decentralized. Although, yeah, I mean, we're still finding the limits of how it works. You know, it's for Ethereum. Governance is far from perfect. We saw with the ProPow, that whole debate and how that was carried out, that there is no actual, and maybe that's because it's decentralized. There's no organized way of doing things. You know, anyone can join like the dev calls, can make a suggestion. Anyone can come up with an EIP, and if they get enough consensus from like the community, the developers, it somehow goes through. But that is pretty rare.
Yeah.
Which on a side note, yeah, go ahead.
No, go ahead.
I was just going to say on a side note, in 12 minutes, we have the London hard fork, which is like EIP 1559, which like was almost dead for like 1 or 2 years, or it was going to happen, wasn't it? We thought it wasn't. And then a few people went push for it, got support. And here we are today. You know, it is going through because of consensus.
Yeah. And I think what you're going to see on the governance layer is somewhat some traits of what you see in like governance and other aspects of life, right? You know, it's quite difficult to have true governance, one person, one vote, you know, and establish consensus of things. What you ultimately usually have is, you know, influencers, so to speak, that people gravitate to and trust their opinions, right? Because, you know, especially when it comes to code, there's a subset of people that completely understand the nuances of that code, and you know, other people who understand from a high level what's actually going in EIP 1559 are, you know, they have to trust some of the more expert, so quote unquote, opinions and thoughts on what that means. So you do have this interesting dynamic of almost representative governance in a way.
I think that is, you know, that's just the human condition. That one person, one vote never works, because it's not only because of coding, it's because of the amount of effort or emotional energy you put into a project, you know, and you see it all over with any type of committee or any type of governance. But I think that EIP 1559 is a sterling example that, you know, in a longer period, we can actually see the correct thing coming to the surface. Because as you said, Dennis, is that it was stonewalled for a long time. And, you know, a lot of people didn't like it. And you know, to sort of simplify things, they didn't like it because it was going to affect them, you know, financially, and they were going to lose out for it. But ultimately, we believe that it was the best move for the community. And it looks like it's going to be, you know, it's going to go through. The miners are going to adapt to these changes, and the better proposal is going to come out. And, you know, if we can get to a governance sort of, you know, at this stage, we'd like to argue that it's semi-decentralized, but, you know, with the team behind it, I think that we continue to push in that we can't actually envisage or see what is going to happen in the future and how that is going to work out. And if you ever get to a point, like you correctly said, with Bitcoin, where true decentralization is reached, have we got to a point where we've locked ourselves out of innovation? And I think these are the questions that we constantly grapple with. So, you know, guys, we've still got 8 minutes or 7 minutes to go. So let's try and, you know, we'll slowly start wrapping up and trying to give our audience some type of sort of answer. And I know it's a very difficult question, but where do we see Ethereum going? Is it here to stay? Is it the de facto choice? Or have we got those projects like Cardano? I mean, Cardano is a project that we've seen, you know, it's taken a totally different approach to Ethereum. Ethereum has just hit the floor running, and you know, Charles Hoskinson has really looked and tried to make sure that everything is done meticulously, hoping that it works at the risk of really losing market traction. What are your thoughts on that?
I mean, my question is, why has it taken so long, right? It has been around for such a long time. And I mean, my understanding was it wasn't even promised to be a smart contract. I don't know, maybe because I'm not too connected with it. I'm following it at a superficial level, so maybe correct me if I'm wrong. But then the smart contract narrative around Cardano came much more recently. And yeah, I don't know where they're at, what kind of consensus layer they have, but yeah, it's something to watch out for.
Yeah, I mean, I could say that the conversations we have with DeFi protocols and NFT, that's typically not a layer one that's mentioned in that conversation. It's more a conversation around the EVM compatible chains, and also, I know Solana is coming out with some version of that as well. But the EVM compatibility allows dApps to quickly deploy onto other chains. So the conversation has been around that, and I think Polygon has done a good job, in terms of kind of showing what the future might look like in some respects. They bootstrap with a lot of incentives. They have the fast scalability, and they were able to get very strong user adoption, in a relatively short amount of time. I think we're talking 3 or 4 months now, since they've really pushed out that program, and you've seen some strong liquidity and growth there. So with that said, there remains to be questions. There remains questions on the security of that and the decentralization of that network. So I think what you're going to see is things learned from each experience. So from that experience, you learn that the liquidity mining works, right? People can move for that. But what we may need to see is whether or not you have a more scalable and secure network that can do that as well. So also bridging matters, right? I think that's another thing that we haven't really talked about today, but is going to be a very contentious point moving forward, is the bridging of assets and sort of the fragmentation of those assets across all these networks is going to create new opportunities for various protocols to kind of keep that composability, but also, not lose the ability to kind of move multi-chain.
I like the example you gave with Polygon, and I think you're so correct in actually showing it has got huge adoption, like scary fast, how it almost crept up. Everyone seems to have ported over, including like Kyber ourselves as well. But on the other hand, it's still like, I think 8 multi-sig addresses that can control and access like the whole thing and give someone like a really like bad day. It's scary that it's actually like that. So, that's not perfect. And then, Richard, like for Cardano, it's a matter of what kind of compromises, what kind of benefits and risks does it have, basically, for us to be able to judge it and then see how it does with adoption.
Yeah, and the other thing is, like, in bull markets, you kind of have this moment where everybody just tries to like push each other's face and kind of run really fast. But what I think is really interesting from our perspective, I can speak of what we're doing, kind of where we see Avalanche going is. We do think that, having a secure network that's actually decentralized is still the vision. So we have over 1,000 validators right now. That's, not much that any other chain can really say. So that's quite exciting. But we still do have that very fast transactions per second. So now taking lessons from various other situations, we can kind of see, what works in terms of user adoption, but without sacrificing some of that scalability and security, which we think is still paramount. It's funny with security, nobody cares until they do. So it's and then when they do, everybody cares. So I still think that's why we got into this space. We go through these kind of iterations where we're like, okay, we need speed. Let's go get speed. And then we're like, well, we really didn't do it the way we were supposed to do it. So we need security. And then we kind of like go back and forth until we find that right balance.
I think, Luigi, what you said, the fact that we haven't really, touched on bridging or interoperability is a key factor, because, Polygon or Matic is very admirable. I'm very excited about the fact, they've got side chains, they've got layer 2s. They've had huge adoption. A lot of people asking what will happen to, Polygon when Ethereum 2.0 comes out, but they've got such traction that I don't think that it's really going to have any effect. It's going to be something that people are going to get in and use. A lot of people are going to only know how to use that, and they're never going to look left and right, just like Ethereum, just like anything in life. And I think that is something that absolutely fascinates me. I ask questions like the fact that Polygon is able to function using the full security of Ethereum is extremely impressive. It sort of attracts me. And the fact that it's able to function independently, is this something that we can expect to see more of? These are absolutely fascinating topics. I'm very, very bullish on Matic, just by the way. I believe it is one of those protocols that I'm watching closely. And it's Yeah. Okay, guys, we've got a couple of seconds. Let's just do our wrap up. So if you want to start, Dennis, with your closing statement, Luigi, then you, and then I'll wrap it up and we'll be out of here, guys.
Yeah, I mean, just to wrap up and add to what you said before with the Polygon, how it's grown, it just shows that it is kind of possible and there is demand for it. Yeah, but I think I'm incredibly excited to see what everyone's kind of building, and I welcome all kind of competition. I think it's all part of this innovation curve. We're all like 5-6 years ago, no one was in the space, and we're all learning together, basically. So yeah, it was really nice to be on this panel with you guys. Very interesting discussion, and let's see how this conversation will hold up in 20 years' time.
Yeah, and just for me, this is likewise, I can echo those sentiments. This is, a good conversation, one that, I feel like I'm having daily with various protocols. But yeah, in terms of what I think and what we're doing at Avalanche is that there's going to be, this future where you have multiple blockchains and that maybe some will carry some niches and some won't. But there's going to need to be more than just one. And what I'd say there is that, for our perspective, we have a lot coming out in the next few months that's very exciting, and towards that user adoption, and I think we'll kind of see where the chips lie in terms of what's the best consensus, what's the best security, what's the best speed and scalability chain as well. So
absolutely. So guys, just in conclusion, and I think we might have missed one or two questions, sorry about that, but is Ethereum going to be the de facto choice? I would say absolutely. Right now, it's definitely not going to be thrown over very easy. In this space, you would be crazy not to bet on Ethereum, but that comes with a caveat of make sure that you keep your eye on the ball and make sure that you know what is happening, because it is a space that changes probably slower than you think, but that constant change and that constant momentum is what actually drives us forward and makes the change. So Ethereum, definitely here for the short to medium term, and possibly here for many, many years to come. That's it from us, guys. Thanks very much.
Thank you. Bye-bye.
Thank you. Bye.
To the State of Regulation panel, who is ahead and why in the world of DeFi? We've really got a very exciting panel planned for you today with amazing experts from all over the world. We have Joshua Elul, the director of the Center for DLT at the University of Malta, and he's also the chairperson of the Malta Digital Innovation Authority. We also have with us Agata Ferreira. She's the expert at the EU Blockchain Observatory and Forum and an advisor for Blockchain for Europe. We also have Tufik Adluni, co-founder and managing director at Renault & Co., a boutique law firm specializing in emerging technology law. My name is Narushka Bowen. I'm a director and the head of technology and innovation at Norton Rose Fulbright, South Africa. So I'd just like to give each of our panelists a little opportunity to tell us a little bit about the work that they do and why it's relevant to the discussion today, which is DeFi regulation. Joshua, if we could start with you.
So I'm involved in mainly two activities that are relative. So one is in education, particularly in a multidisciplinary master's in blockchain. And that's important because especially in this space of DeFi, we're talking about legal aspects, financial aspects, and of course, the technical aspects. And then I'm also chair of the Digital Innovation Authority in Malta, which is responsible for providing regulatory frameworks for the technology, which will then be further regulated by the financial authority.
Thank you so much. Agata?
Hello, it's wonderful to be here. Thank you very much for having me. As you have mentioned, I am an expert at the expert panel of EU Blockchain Observatory and Forum, and also advisor to Blockchain for Europe. I am also an assistant professor at the Warsaw University of Technology, and I teach and research at several other European academic institutions where I focus on education and advisor work on blockchain innovation in general, on intersection of law and technology. And through my work, I collaborate with the industry members, with policymakers, with other scholars, professors, and we try to develop policy frameworks for blockchain innovation in general. This is my focus. And in my some years ago, I worked for over a decade in the financial sector in London as a solicitor, and I worked on structured finance, so always on the edge of what is possible in financial tech, in finance, in law in general. So this is a short introduction from me.
Thank you so much for sharing. Tufik?
Hi, everyone. My name is Tufik. I'm a practicing lawyer for a number of years in blockchain and digital assets. I started out in digital asset and blockchain law before it was cool. So happy to see everyone has come to the party with me as well. Our law firm is headquartered in Montreal, Canada, where we have practicing lawyers in the United States and in France. What we work with primarily in the DeFi space, we work with a couple of interesting clients from a technology standpoint, building out kind of DeFi protocols and ecosystems, from a trading platform standpoint, as well as a trading bot standpoint, allowing people to automatic stake and unstake or create some sort of data aggregation platforms to be able to analyze different DeFi trends. We also work with some other interesting financial institutions like a DeFi bank and whatnot, which is very exciting to see kind of come to fruition. And yeah, it's been that's a bit of a scope of the work that we're doing in DeFi.
Sounds very exciting indeed. So looking forward to what all of you have to share during this discussion. So I'm going to dive right into some of the questions now. For our audience, you are very much welcome to also share your questions in the Q&A box. And towards the end of the session, I will be picking one or two of those to ask the panel as well. So please do share there and your comments in the discussion box as we go along as well. Agata, if I can start with you. I mean, I really think we should, frame the context of this discussion as well. There may be a bit of confusion as regards to cryptocurrency regulation and DeFi regulation. What are we actually talking about? Could you perhaps start us off by maybe sharing a few DeFi use cases and really the differentiation between crypto regulation versus DeFi regulation?
Yes, I think it's important. Thank you for this question, because DeFi is a nascent phenomenon and it lacks a great definition and clearly defined terminology. So there are indeed many misconceptions and confusions surrounding DeFi. So far, DeFi has been described as many things, as anything from protocol stack to loosely defined collection of ideas and projects. It's been defined as a movement or as an economic paradigm shift. It's not a strict technical term, DeFi. It's not a singular occurrence or any particular project or any particular mechanism or technology. It's rather a multi-dimensional and dynamically evolving phenomenon that is part of this progressive decentralization enabled by blockchain technology. So even though current DeFi applications are still limited to a set of financial applications and products, the catalog of use cases will certainly expand, and the composability characteristics of DeFi allows for limitless future developments and configurations of DeFi applications. So DeFi is a broad concept that describes this emerging area of finance, and the term is often used in a misleading way, not always intentionally, to describe a variety of products and applications, and those may be really very different from each other, and some of them may not be decentralized at all and still be called DeFi. And DeFi, there are certain hallmark elements of DeFi that can help to identify what DeFi projects are. And DeFi leverages on main blockchain features. So it's characterized by being open, permissionless, disintermediated, and with no single point of failure. And the spectrum of DeFi is very broad. So the exact degree and mixture of various technological and governance features determine just how decentralized a particular DeFi project is and whether it is in fact at all a DeFi. So not every application calling itself DeFi is true DeFi application. And DeFi does not refer to one specific thing. It actually signifies the entire emerging ecosystem of composable building blocks of DeFi, financial primitives, underlying blockchain networks, and the whole crypto assets, and the whole community of developers, operators, and participants of all kinds. So from these new fundamentals emerged traditional financial products and services like lending, like borrowing, like derivatives, and more. So DeFi ecosystem has this multi-layer structure comprising various levels of ledgers, assets, gateways, and applications, etc. So when it comes to distinguishing DeFi and cryptocurrencies, it is important to understand DeFi architecture. It's dynamic. It comprises layers that are built on top of one another in this hierarchical manner, facilitating composability and creating various interdependencies. And the bottom layer is the settlement layer, which comprises of blockchain networks like Ethereum, for example, which is a foundational element of DeFi architecture. It is where transactions are settled, verified records of transactions are stored, and the next layer, the asset layer, represents the assets. And this is where cryptocurrencies come in, as these assets can be native to blockchain networks like Ether, or can be other tokens like NFTs or stablecoins. So when it comes to practical use cases, DeFi offers several products which are similar in essence to existing financial services. And due to this flexibility of underlying protocols, novel services and products will certainly be developed in the future. But at the moment, probably lending is currently the leading DeFi product with the players like Maker or Compound or Aave being a popular choice with DeFi participants. Any user in DeFi space can lend their crypto assets to other participants and earn a return. And there are various ways in which lending can be done. Each lending protocol is different. And DeFi gives also opportunity for borrowers for activities like arbitrage, trading, margin trading, or flash loans. Decentralized application is another example of use case of DeFi that enables P2P trading through automated smart contracts. And it does not involve centralized entities or intermediaries, and all trades are performed and settled instantly. And as a result, they are non-custodial, which means that the assets are stored and controlled by users themselves through the use of private wallets and keys. Derivatives is perhaps another one, still minor compared to other DeFi products, but the opportunities for diversification of the crypto asset landscape, hedging, and creating novel and sophisticated instruments are enormous. And there are other currently less prominent products like insurance, asset management protocols, and aggregation tools. So in terms of regulation, it's really important to distinguish the regulations that are targeting cryptocurrencies alone, and regulations that are kind of perhaps are designed to broadly address DeFi space in general, because it is really very broad term and comprises many aspects that involve DeFi space, not only cryptocurrencies.
And I really appreciate that explanation, and I think you've set the scene well for the rest of the discussion and given us just a bit of context, in terms of where this conversation is headed. So thank you so much for that. Tufik, if I can go to you now. I mean, many countries have to date focused very much on crypto assets or cryptocurrency regulations. Could you perhaps give us an overview on that type of regulation? Which countries have really taken the lead when it comes to financial regulation of cryptocurrencies? Could you give us some examples of those jurisdictions? And then further to that, have those same countries made any developments with regards to DeFi regulation?
So I think we can, broadly speaking, put national policy considerations into two buckets. I think there is the first bucket in which the legislature has decided to draft a digital asset specific legislation in which governs the nature of the digital asset space. and the other bucket would be that the legislature has not done any kind of legislative action of the sort and is essentially leaving it up to the regulator, whether the securities regulator or otherwise, to actually produce policy considerations and different types of staff notices and interpretations to set guidelines and rules within the existing framework, which is colloquially called the law of the horses. So I think both ways have positives and negatives on how they can work and not work. However, I would say that as someone who understands the extremely fast-paced and evolving nature of the space, for instance, DeFi in and of itself was something that was quite novel and started appearing in earnest probably in around 2018. There are certain considerations to be done on both ends. So with the current structure, which is taken by, for instance, the United States and Canada, in which they essentially state, well, these are the laws, these are our interpretations, and how they essentially apply, with some exceptions. Obviously, Canada did amend its anti-money laundering and terrorist financing legislation to incorporate, for instance, virtual currency as a definition and to regulate a virtual currency to virtual currency trade. But having said that, the reason why they essentially have done something of the sort is based upon historical context in which they believe that the market is still extremely novel and want the market to essentially mature to a level in which they feel comfortable when it stabilizes to understand if there will be a specific legislation that needs to be passed or if the existing framework can be applied. The other aspect, I think, is led by maybe a couple of more micronations. I think the standalone legislation, which I'm very familiar with and I very much adore, is DABA out of Bermuda, which is the Digital Asset Business Act. The Digital Asset Business Act is actually quite a profoundly innovative piece of legislation, I find, and I do definitely commend Bermuda for drafting it, and other nations have now followed suit with a similar version to that. This includes the Cayman Islands, and the BVI is also considering passing legislation on the basis of DABA. And what essentially DABA does is it gives a certain license to any company, really broadly speaking, that is dealing in virtual currency or digital asset space, and creates a very bespoke and case-by-case registration process in which the BMA, the Bermuda Monetary Authority, has certain guidelines in which it is to apply. So this kind of solves the issue with respect to an extremely ever-evolving market, because the way in which the legislation is applied is extremely discretionary and up to the BMA to decide how it is to be applied. So when,
Director of ETH Berlin, an expert in the wonderful Berlin culture, organizer of hacking festivals, and experimenter with the NFTs and other projects related.
Regulators and legislatures, DeFi was not really on the forefront of legislative discussions, but because of the way the legislation was structured, if you do have a DeFi kind of idea or product or something of the sort, you can then kind of produce it to the BMA and receive one of their DABA licenses. Having said that, I think there is going to be maybe a much more broader kind of cultural clash, and policy legislative endeavor that we've taken since Parliament has been created has been very much done based upon responsibility, and on the basis of putting someone responsible and actually accountable for certain actions or producing certain obligations on those parties. So it's going to be a very interesting potential change that needs to happen in the future. Either that there will need to be some sort of centralization, or centralization will be imposed upon.
Do you think has the adoption and regulation of cryptocurrencies been in your jurisdiction and jurisdictions who have taken a similar kind of forward-looking approach to these types of regulations? Do you think it's stimulated DeFi development or even DeFi regulation? What are your thoughts on that?
So like Agatha said, DeFi includes a whole spectrum of activities, from like heavily decentralized DeFi to DeFi that is less heavily decentralized. And really what I would say is regulators, we all started with looking at the traditional crypto, and it's funny that if we could say traditional crypto, but DeFi in general is gaining traction. And it's on regulators' radar. However, the thing is, I think we still haven't come to terms with exactly how to regulate crypto. Now, some DeFi will fall into crypto regulation. It may not adequately provide what is required for DeFi, but you could say that currently some forms of DeFi are being regulated because of the crypto laws. However, there are still many challenges that need to be overcome. Now, when it comes to whether creating a regulatory framework does promote innovation in the space, definitely. So, and back then, including myself, many were highlighting we need harmonized regulation across Europe, right? And Europe is working on this with the whole MiCA laws and everything else. However, the thing is that now that there's proposed harmonized regulation, we've really put the brakes on, and I imagine this is the same for other European countries. We put the brakes on coming up with new regulation, with exploring how should we regulate DeFi, because we're waiting for the laws to come from Europe. And in hindsight, I'm starting to wonder whether harmonization at such an early stage is now going to potentially not allow for Europe to explore the different possibilities to regulate. And the state still has this luxury, because each state can propose its own regulation, and perhaps that is one way to find out what is better regulation to promote the sector. So these are the two different scenarios we're seeing now, where there's still liberty regulation and the brakes on to see what the powers that be, the higher powers that be propose, host decentralized organizations. And I think that's a good place to start looking into.
Well, that's interesting you bring that up.
Yeah.
Well, I was just going to add that Wyoming did pass a DAO structure, which is being somewhat discussed because it's a DAO LLC. But, and I know that the Australian Bar Association had just requested for the regulator to actually create also a DAO entity. As in practicality now, when we're creating decentralized organizations, we are actually using a not-for-profit.
So the existing design of the traditional financial sector is the result of long-term fine-tuning through diverse processes, compromises between competing interests, market movements, and various policy decisions. And there is no precedent for DeFi, and we are still at the very early development and experimental stage. So far from that kind of maturity, and we should expect this process of developing frameworks for DeFi, as well as standards, codes of conduct, and everything else, to take some time. So this is not something that is unexpected or unusual. This is just the normal kind of process of adapting to new solutions, new technology, and in this case, new or adapted regulation that will be supportive of that space, of DeFi space. And I acknowledge that DeFi creates additional set of risks and challenges, but they result from an early experimental and dynamically legal compliance and other emerging risks. Let's not forget that DeFi lacks the intermediary layer and
some research and to get what they're looking for through the internet. At the same time, the space is extremely crowded, confusing, and there's a lot of fake news. So it is difficult to navigate the space and to also filter what is what is true and what isn't true. Maybe what is true for you isn't true for somebody else. So I think we're kind of left in a space where we have to be, self-educated. And I think
of, for example, consumer protection or risk mitigation without compromising fundamental features of DeFi. Because imposing centralization on DeFi project is in a way defeating the very purpose of for which they were created. There are no regulatory precedents, and regulators have to yet develop a consistent and adequate approach. So my high-level recommendation would be to formulate important policy with the traditional rules may not be adequate approach. So as Joshua was saying, there is a lot of education that is needed, acknowledgement that some of the risks are shifted through technology. And as an example, for example, set of contractual representations and warranties that would serve to allocate the risks between the counterparties in traditional transaction. In DeFi, this risk is shifted from an enforcement risk to a protocol risks, and that is also a change that regulators should acknowledge. So to start with, certainly KYC and AML will be the first target of regulators, as we can already see at the global level, at the FATF level, and also in the US, some of the
direction, and I'm an advocate of that direction.
Thanks so much. Tufik, if we could get your kind of views on the regulatory future of DeFi, what would happen in your ideal world? Where do you see, I mean, should we even have regulation? I mean, that's another angle. Where do you see us headed?
Mm-hmm. Yeah, I heard once a funny quote where someone said, if cash was invented today, it would be illegal. And I think we have to kind of keep that in mind when we're looking at different kind of policy considerations in the way forward. But I think the way we would need it to do is really potentially create something that works for the industry, right? And we're already seeing potentially flavors of that, but I think it's going to be really, as lawyers, the way we do AML diligence is actually really cumbersome and quite annoying, right? You know, it's like, give us your 3-month bank statements and place comments on every transaction that's over $10,000. You know, like, how does that actually protect us from anti-money laundering, where there's many ways of actually going about it, whereas on-chain analysis does way more than, you know, someone at a law office kind of going through and getting comments on each line item on a bank statement. So there is a lot of interesting things that I think we can do. And on a final point, I would say it is really our thought leaders and entrepreneurs and practitioners to play a very active role in discussion and engagement with international regulators.
A good way for moving those NFTs from a metaverse to a wallet to something else and attach, I would say, functions to it that you could perform, such as, for example, the royalties for an artist or anything else that a brand want to carry with the NFT itself, you know, as a sort of like legacy. For an artist estate, for example, it will be very difficult for established brands to continue investing in the space, especially for the gaming industry, but also for art. So I think until we'll live on the day where interoperability will become seamless for all of us will be a challenge. So I think all these chains will have to talk to each other. Same as people, we'll have to agree on a common standard that could be a common ground, a common base for NFTs. Because at the moment, we are just seeing, you know, different chains coming up, and we don't know whether Ethereum, Bitcoin, or what else is going to stick around. So there's a bit of fear of the unknown. You know, where am I going to invest? How much will Ethereum be worth tomorrow? So I think all of these creates a lot of uncertainty in people because we like to have, you know, the certainty of knowing what will happen and to be smart about things. So until those things will be not fixed, I wouldn't use this term, but, be moderated, or in a way be more clear to people, people will then like to play by the rules, I would say.
Can I jump in here, Christina?
Yeah, no, I wanted to mention that what you, Serena, mentioned as fear of unknown is also can be this excitement about different things happening in the industry. So it's basically two different sides of the same medal that Jillian mentioned before. Yeah, Jillian, please go forward.
I'm excited listening to Maria, and I think there's two things that jumped out at me. One is the whole idea that going back to regulation, and Maria got it perfectly. There's good regulation, there's bad regulation. And if you regulate to help an industry, that's good.
With a vision to empower users by explaining the confusing nature of cryptocurrencies to a broad audience and making the modern tools of wealth generation accessible to all. We like that, don't we? Aaron is a former Utah State legislator, USA, and president and CEO of Blue Castle Holdings and Power Block Coin. Aaron has chief responsibility to oversee the development of the leading new nuclear plant and project in Western US. Welcome, Aaron.
Hi, thanks for having me.
Wonderful to have you. Please take it away.
Thank you. I'm going to start off by saying I hope this is a discussion. I know that with the attendees that are here, I always do better and when I have a little bit of a dialogue and can answer questions. So I hope everybody asks questions. I'm also going to rearrange my set here for just 1 second. It's a privilege to be here, and I hope there are a couple of things that we can accomplish from this topic. Obviously, the topic of DeFi sheriffs, right? This concept of a sheriff is a historical one that has a lot of parallels to crypto. We're going to explore that, about regulations, also about the design of technology related to that. And so I'm going to open up my slides here. Give me 1 second. Start it there from the beginning. So I'm going to try to stay on task here. I'm going to set a timer here to make sure that I'm not going late or running long. So the first thing I think we ought to do is introduce sites that we have from our previous experience, which is, and my previous experience as a policymaker, and then also our experience engaging with regulators from the nuclear world, how that applies to crypto and to DeFi, and what lessons can we learn historically from the past as it relates to the adoption of new technologies, the protection of property, the use of that property. And so there's an enormous amount of parallels that with either your project or your use of cryptocurrencies can be very valuable and save you a lot of headache and trouble. So I'm just going to talk a little bit about myself to give you a backstory. As Lavinia said, I was a former state legislator. I was elected in 2004 and then re-elected in 2006. And previous to that, I was actually appointed to that seat, which is kind of a crazy story. I'll tell you about it here in just a minute. But it was I was about 32, so I was a little younger for an elected official, and a little bit of in some respects, it was kind of a sad tale, but a very eye-opening experience of how I got to where I was at that time. Sad for one individual and kind of exciting for me. But so some of the committees that I served on in the state legislature, I was in the House Public Utilities and Technology Committee, was the vice chair, which that committee was involved in regulating utilities that provided electrical services, gas services. I was also on the House Retirement and Independent Entities Committee. Has some parallels to cryptocurrency, obviously investments. People are buying crypto for retirement purposes. And was the vice chair there. And basically we made laws that regulated utilities and how they received their compensation, how people could engage in retirements, and a lot of other things related to the state of Utah. Also, we have a company that is the parent corporation of SmartFi, where we develop a new nuclear power plant in Utah, so here in the western U.S. And then obviously, as you can imagine, from those experiences, we've engaged with many state and federal regulators in regards to nuclear power plants, or in passing laws to help enable regulators to provide their oversight for public utilities or retirement entities and investment. So a lot of experience there, I think, that we've taken from that past and applied it to cryptocurrencies is just very applicable and kind of enlightening when you consider where we are and what's happening in the space. We've seen a lot of potential legislation in proposed bills, one of which the infrastructure bill here in the United States, as it relates to mining and nodes. They're trying to force those entities to take on a role of almost a regulator-like position. Then also there was a bill introduced a few days ago that was very sweeping in its proposed regulations for cryptocurrencies, which would actually be very detrimental. And I think it's a little bit of a warning bell that people should be paying attention to this consideration, that as crypto continues to gain more notoriety and a little broader use, it's going to wake up the regulators in this space and the politicians who feel compelled to quote unquote solve problems and basically address what their constituents might have in concern. So with that, let's talk a little bit about this kind of reckoning that we are having and that'll continue to happen. And I liked the concept of sheriffs for this reason. Historically, sheriffs were the outgrowth of the serfs, which are basically the common people. Back in England, about 9th century BC, that word sheriff had its origins there. There was the serfs would appoint or band together to appoint a person called a reeve, and this reeve would basically represent the serfs in an informal way to the king. So when they had complaints about the way the kingdom was being run, or the oppression, or taxes, property, all of those things, he could address the king and try to bring up these issues. And so he was the informal individual who would represent the serfs to the king. And in those days, they had a geographical boundary called a shire. So you might recognize that from Lord of the Rings or The Hobbit. The word shire was kind of a location, like a county, comparable in the United States. So the reeve would represent a shire, and over time they shortened up this connotation to be sheriff, and that's where it evolved into the word sheriff. And it was really an outgrowth of the common people wanting to have reconciliation to the king. When he did something that they didn't like, they would protest or go through this sheriff to get it addressed. So that word sheriff has been adopted in a lot of different places around the world as the world kind of developed here in the United States. If you remember the story of Robin Hood, you had the sheriff there, the sheriff of Nottingham. Right, and here in the United States, kind of more famous is the sheriff, the image of the Wild West. So when you had homesteaders who had moved from the East Coast in the early days of the United States, they moved west. People would homestead, they would claim property, and they were building up their societies, much like the parallel of in the early days of cryptocurrency when Bitcoin first came out. it was really, Bitcoin was an appeal or a choice, a secondary choice from fiat currency. And this new choice, or this new type of property, eventually was going to be brought up into these policymakers and regulators. So we have a very similar thing that with these new communities that were cropping up across the Western United States, or as a serf in England, in your shire, you had to have a sheriff that would help represent you and protect your property, and could actually enforce by violence the protection of that property. And in the Western United States, obviously, this concept took life, and as you became a member of that society or that network, like a cryptocurrency network, or the society that you lived in, a city or a town or a shire, you had to reconcile with that sheriff. And so this concept is centuries old, but we have to learn from these past examples, or we're going to make the same mistakes that occurred then. But these sheriffs are endowed with varying degrees of power, and with this power, you get kind of the good, the bad, and the ugly. You know, to reference a Western movie, and the necessity to evolve from a shire or from a small town with your sheriff into a city, or into a metropolitan area, which is really what has to happen for the Wild West. That analogy has been made many times of cryptocurrency, that the cryptocurrency and DeFi is like the Wild West of finance. So what sheriffs do we have? How do we gauge kind of the demands that society might make of this? And I want to give a cautionary tale here as well, that these sheriffs that evolved in England in the 9th century, they were appointed and given power to represent the common person, or the serf of that society. But over time, what happened was the king recognized that the people endowed this sheriff with power. And the king then repurposed or structured and gave new power to this sheriff from his side of the ledger to actually make him a tool of the crown. So initially, when the sheriff was built to represent, or empowered to represent, the common person, the king took that power that sheriff was endowed with by the common people and turned it and used it against them. The sheriff now became a mechanism to collect taxes or fees. And I want to caution you again, the designs of cryptocurrencies have a tax-like feature in transaction fees. And that tyranny of that fee, we've seen that crop up several times, where it became, the fees on the cryptocurrency networks became punitive. So we're going to talk a little bit about that. There are lots of parallels if you really understand this concept. Technology,
which companies will be organized, will simply just happen. It's only that in the real world, things take longer to be adopted and simply just formalized in the way normally things work. Legalities around those things will require a bit more of time and study. But I think step by step, we're here to influence and educate people about this. And, I think continuing doing what we're doing, which is simply just talking about this, has already been helping a lot, because the word NFT only came out a few months back, I would say, even years, on mainstream. And we're now simply just attending conferences about blockchain and NFTs nearly every day. So it becomes part of our daily vocabulary without us realizing how long normally it takes for something like this, so huge, as a concept to understand and embrace, to be part of our daily life. So I think continuing on the education part and following projects that are actually supporting, not just on the art and collectibles, but in all other industry and fuels would definitely be of interest for many.
Awesome. Thank you very much, ladies, for your insights. It's been a pleasure to talk to you today. I share your fascination about the market, and I think that instead of just being a digital development in general and progress, it's actually connecting the world, the dots in our digitalized, globalized world, and creates new connections between within the community, between different actors involved, and this is really exciting. And I guess it's incredible how digital technology actually can be human and creative and natural. So thank you very much for joining the panel. Thank you all, the public who watched us, and thank you very much for the organizers. See you soon. Follow the crypto and blockchain news. Enjoy the art.
There may be broader acceptance, and the use of crypto may become more broad. It is not the same as decentralization. The danger of decentralization is it can turn into mob rule, which is just as terrible as tyranny. There are lessons to be learned from history about cryptocurrency and about the evolution of a new technology. So we're going to talk a little bit about, one, the potential of cryptocurrency, and two, the ability to take those enhancements, integrate that with what society demands, but then also retain its independence and its freedoms. And that's really what cryptocurrency is about. It's about to use your property with freedom and protect your wealth, similar to the sample, the existence of the shires and the development of the reeve, who later turned into the sheriff, and then the government turned the sheriff into the tool to collect taxes from the serfs. So you've got to be really careful, make sure that you maintain your independence, and that starts with the core designs of the technology. There are a lot of the designs of cryptocurrencies that I question, not because of the intent of cryptocurrencies, but maybe a little bit of the ignorance of the designers, that they weren't really clear on what they were building. They knew that they wanted to replace something, and over time it has to iterate. So let's just talk about what has to happen for these things to be adopted and to avoid becoming a tool of the government or becoming obsolete by not being accepted into society's moral standards. So the three objectives here with the tools are, one, of governance. I think everybody's familiar. If you use cryptocurrencies, you hear that word governance or DeFi. Two, value fundamentals are very critical. Where does the value from what we're doing come from? What activities does it promote? Does it promote societal standards, or does it promote maybe a little bit of lawlessness? Payment systems. If payment systems become a structure to collect taxes, now you become a tool of the government. Or the system that is collecting those transaction fees can become a tyranny. They can oppress you just as easily as any government does. So we're going to talk about that. So the design of your project or the design of the use of these assets must have superior equality and moral designs technically to be accepted by society as a whole, and to keep from becoming a tool of government or becoming a tyranny under their own existence. So without these superior benefits, no technology will survive. It'll either be made illegal by a government, or the users will see that it has become its own tyranny. So in some of these slides, I might blow through. And if you have questions, again, please raise your hand. I can't really see any of these questions yet. I think they're going to save them for the end, so I'll try to save about 10 minutes till the end of this presentation. But I may blow through some of these slides, not address all of these issues, or I may hit some of them selectively. So let me talk a little bit about the experience that I've had and how you have to kind of change your mindset. When I came into government, and I'll tell you this crazy story a little bit, and I'll try to be quick. My first experience for running for office was over taxes. I thought that there were certain taxes that were punitive and unnecessary. And so I ran on a kind of a less tax platform. And I'm trying to get to the point quickly here. But the guy that I was running against had voted for a tax on cable TV. And I thought, what's the point of that? Why do we need to tax cable TV? Right? And there were a couple other things that he voted to raise taxes on. All in all, was he a terrible guy? No. But there were things I found out about later that made me question his moral judgments. And later the voters punished him for certain things. But so I started running against him. And there's this process where you run for office where you have to first get on the ballot by becoming your party's nominee. I was a member of the Republican Party, still am. And he was the incumbent. So you had to run in this process called a convention to become, and you had to convince certain delegates that you were the good guy for the ballot to then be put on the ballot and then run against the other party's candidate to eventually win the election. So we went through this convention and I made it by 2 votes, which means I didn't become the candidate outright, but I brought him into a primary election. So now we had to go to this broader election where tens of thousands of people that are members of the party would vote on who was the best candidate. And so I was knocking doors, trying to talk to these people and make sure that they would vote for me or try to convince them to vote for me, go through this process. And I got a phone call from a newspaper called the Deseret News, which was a statewide newspaper that basically wanted an interview. And I said, hey, I'm knocking doors right now. I can't talk to you, but yeah, I'll talk to you later. So anyways, later on that day, we talked and he said, I wanted to congratulate you on you're becoming the state representative. And I said, well, wait a minute, but the campaign's still going on. I haven't won. You must be confused. And he said, no, let me explain to you something. We're going to be breaking a story about your opponent tomorrow, and I need to get your reaction that he was arrested 4 months previous. This was in springtime, and he said in later end of last year, he was arrested for solicitation of a prostitute, undercover cop who was posing as a prostitute, and he pled not guilty or pled no contest and was convicted, and hoping that nobody would find this out about him and still running and still fulfilling his office. And he's agreed that he's going to resign. And since you're the only other person running against him, you're it. You won. And I was shocked at first. Then I was saddened because I thought, man, this guy has got, tomorrow his world is going to implode. And, you kind of feel a little bit of sad for him that he made such a stupid choice and behaved in such a stupid manner, one morally, but also publicly. His life is about to change dramatically and be incredibly embarrassed, all of these things. But at the same time, I thought, well, if you're going to be a public official, you need to be beyond reproach. You need to exhibit in your personal life and your public life a moral standard that people will accept. And not only just for public appearances, but if you're putting yourself out to be a guiding leader like cryptocurrency in the DeFi space, you better live up to the standards that society expects of you and the users and or the people who will vote for you and support you. You cannot have a double standard. So that was my crazy experience in my first experience into politics, about how brutal it can be. And the same thing with DeFi and cryptocurrency. If you have some success with your platform and using it, It doesn't necessarily mean you're going to be accepted by society. You got to be very careful. And the designs of what you're doing have to exhibit the moral standards of society. So here are kind of these 5 points I want to get to. And one, some kinds of success in politics are not measured by those who agree with you. It's measured by those who are not rewarded for opposing you. Very different. You find out pretty quick in politics, the enemy of my enemy is my friend kind of thing. And or you don't always know people's motivations. And as long as you can get people to not actively oppose you, that's just as good as winning and getting them on your side. Number two, regulators and policymakers already have an ideology and a constituent influence that you'll not be able to influence. Doesn't matter how persuasive you are, how good your product is, all these things, they may never agree with you, even though personally they might like what you're doing. If their constituency and their voters have an interest that is contrary to your product, your goal is just not to make an enemy of them. You will never convince them to support you. What you need to do is get them not to oppose you. So that goes along with number three. Design your product so that the benefit of your product will not allow anybody the opportunity to publicly oppose you. You're trying to frame a debate and capture the public narrative that supports you so that number four can be possible. If somebody decides to oppose you, you limit their forum for opposition. Your product is so good, has obvious benefits to the voters and to the constituency, that if they privately oppose you because they don't agree with your position or whatever it is, or maybe this, maybe one of the sheriffs, a senator or a House member, his wife is the CEO of a large bank. He's never going to like cryptocurrencies, right? So what you need to do is make it impossible or very difficult for him to publicly oppose you because you've gained superior moral narrative, right? And that is something that DeFi and cryptocurrency have not done. We've done a very poor job of doing that. It is okay to publicly oppose cryptocurrencies and badmouth it and do all these things because we'll talk about that we have not captured the moral imperative and made that narrative of superior moral design clear. And five, politicians and regulators will find easier targets if your project has obvious moral virtues and just not technological innovation. Technology itself is not a virtue. And we see a lot of, because this community involves a heavy technical design, developers, they can often get confused that technology is actually a virtue, right? And it is not. Technology is not a virtue in and of itself. It is the choice of using your property and the freedoms that it presents and all of these other things that are the virtues that we need to capture the narrative. So let's learn a little bit of from the past history. I'm going to look at my time here and make sure that I'm not running over. I'm going to move on because we're going to need to provide time for some questions. But parallels from the past. We talk about the Wild West. In the early days, pioneers banded together in governance and appoint sheriffs to enforce the laws. When you select a cryptocurrency like Bitcoin or Ethereum or something else, you're actually selecting a sheriff because you're operating with inside a network. I think of it like a little town or a community. We use that term a lot. And the internet also did the same thing, but its debate was framed a lot differently, as it should have been, because many of the virtues of that that structure and that innovation were awesome, massive, life-changing, history-making, nothing like it in history. But it came with a lot of downside that nobody really talks about, one of which is the massive amount of use of power. You hear that in mining of cryptocurrencies. The internet in 2013 used 107 nuclear power plants worth of electricity. You never hear somebody complain and say, we need to shut off the internet because it uses too much electricity. Nobody's ever said that I can find out, right? It facilitates massive fraud, theft, and privacy abuse, pornography. And the reason for its political support is politicians use it to exploit it for political gain. They have just as much a right or intrinsic need to use it as anybody else to get their message out. I'm going to kind of blow through this slide a little bit. We've talked about this already. Crypto has allowed criminal elements to thrive in the absence of accountability. Just like an old Wild West town, if there's no sheriff, the guys who wear the black hats reign, right? And when I make reference to white or black, I'm not talking about color or race or anything. It's a movie reference that in the Wild West presentation of the wild movies into the Wild West, the sheriff wore a white hat, the criminals wore a black hat, right? And you hear that reference all the time in technology developers, right? Or hackers, a white hat hacker or a black hack, right? So similarities are politicians will call for overly broad restrictions. You have boom and bust cycles like the gold rush of 1847. Sometimes the cure that the sheriffs try to impose is worse than the disease. The technology sheriffs can collect too much in the form of transaction fees or taxes, right? And so you've got to define, are you a hero or a villain? If your role is unclear, that is not a good prospect for you to be engaging sheriffs or policymakers. So you've got to show that your core designs meet society's moral narratives. Here are the problems with cryptocurrencies and DeFi in general. There's a lack of fundamentals, right? It's seen as kind of a get rich quick story, right? And people, although they might like to be the beneficiaries of that, if the other side of the population is not getting rich quick, they see you as a villain because somehow you've taken from them what they should have had. It's kind of a jealousy in its finest form. And so if your beneficiaries have a small use case and the natural constituent is really small, you're a target for regulation. And the use case is really currently around cryptocurrencies and DeFi centered around trading and speculation, kind of the same thing. Most people can't spend all their time becoming a trader. Most day traders of cryptocurrencies and regular stocks, they actually 85% of them lose all their money within the first year, right? Or lose a lot of money in the first year. So 3, unnecessary bear market volatility. There are victims and winners from negative, unnecessary bear market volatility. That narrative it goes way up and everybody's happy, and then it crashes and then everybody's sad. You're making yourself a target for regulation when you have that kind of structure. So and also with cryptocurrencies, there's no solution for injustices like theft or fraud or errors on the blockchain. There's no ability to go back and right the wrongs, like go to court or do these other things. And blockchain use requires perfection of users. 20%, it's estimated that 20% of all Bitcoin is locked in wallets that people have lost the access to their private keys. Nobody would accept that in regular society. If you went to a bank and they said, hey, there's a potential, in fact, it's highly likely if you put in $100, you're only going to be able to access maybe 80% of it. You're going to lose 20% in our bank. That's just the stats. One of which, because we require you to use our platform perfectly. If you can't remember your password, too bad. That's not acceptable in society, right? So the designs of cryptocurrencies and at the core and DeFi have a lot of drawbacks. This is just not acceptable. So it won't be accepted in society. So we also talk about unnecessary taxes or fees. And ironically, the core designs of cryptocurrencies borrowed the worst features of banking and government tyranny. Fees for using your own property. That's not freedom. That's oppression, right? Socialized block rewards. No matter how big the notional value is on the network, the same reward is split among the same network operators, like socialism. That's not a good design, right? And we'll talk about some of those impacts, but I'm going to try to move on here and get to kind of the virtues and kind of the designs. We already talked about that. The value or the virtue in crypto is in choice. We have to capture that narrative and make sure that that's communicated. You need to frame the debate with benefits, right? The long-term benefits. We talked a little bit about this. Need to be clear. Nobody's really clear on what is the long-term view of cryptocurrencies and DeFi's. Everybody's clear that short-term, a lot of people are making money. There's a lot of risk. And when I say a lot, the small amount of people who engage in it make money, but nobody's really clear about that. You need to meet with the sheriff and make sure that the long-term benefits are clear. If these values cannot be communicated, right, and your project cannot communicate these values, you're going to go the way of the dodo bird, right, which is essentially extinct. So I'm not going to spend a lot of time here. I'm going to try to tell you how do you frame the debate? And I'm going to give you some of the examples of SmartFi. Some of the things that we've done in our core designs, and we've spent 4 years designing this from that perspective. We're a user. We've been the victim of a lot of other things. We've had people steal things from us. We've had other problems, incorrect transactions, or a lot of these other things in our early days of learning how to use the network and cryptocurrencies. So we designed our system to overcome these problems, one of which is we built natural constituencies into the form of our loans, small business loans. We don't make a lot of loans to people to leverage in the marketplace to trade on. We make most of our loans to people who are building a business. Those business owners are natural constituents for politicians. Traders are not. It's just a fact, right? Also, we have a 100% buyback guarantee that if you buy our token, you don't like it for any reason at the end of a year, you can come back to us, give us the token. If you buy it from us in our token sale, we'll give you back exactly your money that you bought it with, because we have a different design. We don't rely on speculation in our process. We rely on a hedge. I won't bore you with the detail of how that works, but that is awesome, right? That's a great benefit. It's hard for a politician to say, hey, you have risk in your product. No, we have a way to compensate for that risk. There's risk in it, but we have a way for the natural constituent to hedge that risk. We have a fundamental value creation. Our structure and our platform works off of a lending model, and we index our coin to the lending platform so it can produce its own forward price curve. People can tell what we're going to be worth in the future, and that resists bear market volatility or unnecessary bear market volatility. In 6 months, we're going to be enacting what we call our sheriff nodes. Surprise, surprise, using that language or that name that'll help correct fraud, theft, and errors. Now, there'll be a process to it. I'm going to kind of ignore the rest of these bullets because I think I need to kind of release some of this time for questions if there are any. But the sheriff nodes are an innovation from an experience that I had as a legislator. In litigation, there's a process where you have to post a bond. And if you post a bond and engage somebody in litigation, and it shows that your set of facts represented what was true, and you truly were engaged in litigation fraudulently or without cause, you then can either post the bond and then get that back, and then the other person has to pay you and you win in court or whatever happens, and vice versa. So we've basically structured a process where you can appeal a transaction, but you have to post a bond. You have to put something at risk. So using the same innovative technology of putting something at risk, which is the core of cryptocurrencies, you can do the same thing, but outside of the block, and then get an appeal process and then have a node that will actually reverse a transaction if you go through a process that takes time, requires you to post more money or value at risk. So you better be sure if you're trying to reverse this process or this transaction on the blockchain, one, you better be correct or you're going to have even greater punishment. So it's going to deter thieves and fraudsters from actually engaging in this activity on our blockchain, but give somebody it a way that takes time, could be hard, but give them a way to actually correct an error where it just may be a mistake or you lost access to your wallet or whatever it was. So these benefits that we've incorporated in what we're doing give us a better narrative when we're talking to legislators and other policymakers and other sheriffs about how we're different and what the future holds for what we're doing. They can catch a vision. They can see that society, that those types of reconciliation processes, reconciling to these sheriffs is possible, and they can see how our products will fit into the narrative of society. So we feel that if you don't do this, if you don't engage this in your technology from the design, from the outset, you're opening yourself up to unnecessary risk. And there are ways to innovate this around technology and keep cryptocurrencies ethos and the DeFi ethos intact, but it takes a lot of work. And you can't just accept the status quo of errors, fraud, and theft being part of your business model. So with that, I'm going to end there, see if we have any questions. And if we don't, I'll go through some of these other slides that we can talk about. So Lavinia, do we have any questions?
Fortunately, we don't have any more time for any slides or questions. But I think that's a great point to end on. And I think, in this space, one really has to be brave and courageous and push the envelope so that we can create a better space for many and not just a few. So thank you so much for your time, Aaron. For those who are listening, please, if there was anything that was pertinent for you, that stood out, please go onto our Twitter, share it with our followers, like, share, of course, follow Aaron. And Aaron, thank you so much for your time and your presentation.
You bet. And I'm available. I'm going to stick around. So if you want to get on the app and contact me or our team at our booth, I'll be available.
Awesome. Thank you so much.
Steven, I want you to talk to us because you are a very controversial person, because you are centralized and we are in a DeFi conference. So I need to understand, how come you got invited? Okay, tell me.
Well, I think, unfortunately, centralized everything is a necessary evil. I don't think it's going anywhere. So, I think there's a place, and I think centralized exchanges and DeFi are very symbiotic. Ironically, we have quite a few DeFi tokens listed on Bittrex Global, which is a centralized exchange, and people are trading them there. So that's ironic in itself, isn't it? But I think we're seeing a lot of institutional interest in the DeFi space right now. I don't know if you saw, Grayscale is launching an institutional grade DeFi fund. That's highly centralized fund of DeFi assets. So I think DeFi is an interesting space, and we'll obviously talk about it a lot. But I think you might have a centralized access point to it, and I don't think that's going away.
And very quickly, are you guys planning to move into a more DeFi environment, or are you happy with your model?
No, we're that's not for us. So I think, and again, we think there's a lot of great DeFi projects out there. Super excited about the ecosystem and the space, and we have a lot of really interesting DeFi projects which we have listed on the centralized exchange, to support the space. But that's sort of how we want to participate, sort of focusing on what we do best. So I think, again, it's a great opportunity. There's lots of great DeFi, decentralized exchanges out there. That's just not our business model.
And sorry, you were saying earlier to me that you are operating in Liechtenstein and Bermuda.
Yeah, so Bittrex Global is for the non-US customers of Bittrex, which is a pretty old exchange. It's been OG exchange, but we're very focused on regulation and doing things the right way. We looked around, and for our non-US clients, we found Liechtenstein, which is an EEA member state, a AAA rated country. Swiss franc is the currency. They passed a blockchain act, and so you have 1,000% surety of what your status is, which is the opposite of the US, which you don't know if it's a utility token or not. So I think the EU in general has much clearer rules. And then within that, we chose Liechtenstein because they actually passed an actual blockchain act, which even like BaFin are consulting with FMA to see how to put something in place in Germany. So I think it's very high quality. We have 100% security in terms of like what we're doing there. Every token has a Liechtenstein legal opinion that's considered an EU legal opinion, and it's very clearly spells out if it's a utility token, that it's not e-money. So that it's not a security. You don't have risk of it getting reclassified after you've done it. So that's why we thought it was the best place for this moment in time for our utility token clients. And we do full KYC, AML on everybody.
Yeah, very cool. Thank you. Nick, tell us who you are, what you do, everything about Compound. Tell me.
Yeah, absolutely. So I'm Nick. I work on business development for Compound Labs, which is the team that built the Compound protocol. Business development broadly means anything under the business umbrella. So, around a year and a half ago, that was very focused on talking to crypto native institutions, the exchanges, brokers, custodians, hedge funds, smaller projects that were looking to leverage Compound's interest rates for some sort of product. And more recently has been focused on the non-crypto native institutions. So more traditional fintech, banks, anyone who's looking to do a foray into DeFi and just wants to get past that educational barrier and learn how they can incorporate it into their business processes. So a little bit more on Compound specifically. There are three sort of projects that Compound is working on. One is the Compound V2 protocol, which the team originally built and set live in 2018. Has since processed over $160 billion of supply volume, is sort of seen as a core piece of infrastructure for the decentralized economy, and that our team decentralized and handed over governance to the community in roughly May of last year. So the Compound protocol just allows anyone with crypto to earn interest on their idle assets and allows borrowers to first post collateral and then take out over collateralized borrowing positions, typically for either leverage or liquidity. Sort of expanding on that core concept, the Compound Labs team is now working on a project called Gateway, which is going to bring those decentralized interest rate markets to a broader set of assets that aren't necessarily built on Ethereum. So with Gateway, you'll be able to connect these different peer chains like a Solana or Polkadot and upload assets onto Gateway for different types of applications to earn interest, to trade, things like that. And then lastly, we just announced a new product called Compound Treasury roughly 3 weeks ago. That's more of a managed experience on top of the core Compound protocol. So we built a flow of funds that allows customers to send US dollars. We put that into the protocol for them by working with our partner Fireblocks, and then provide a simple, stable interest rate at 4% APR. So sort of the lowest barrier to entry for financial firms to get involved with DeFi.
Amazing. I'm really a fan of what you guys are doing. It's so impressive. I love it. Eric, tell us what you do.
Sure. Hey guys, I'm the Chief Operating Officer here at Crypto.com, and as you may know, Crypto.com is one of the fastest growing regulated crypto platform out there. We offer CeFi as well as DeFi, mostly CeFi to bridge with traditional finance, make sure fiat can come in and out very easily, and also enable all our customers globally to spend their crypto with a Visa card. And we also have a DeFi offering with our own non-custodial wallet called the DeFi wallet, where we support, I think, 10 plus protocol now, 200 tokens, swap capabilities, as well as the opportunity. We also have a public blockchain, the crypto.org chain, and just launched the testnet of a sidechain called the Kronos, which is EVM compatible and where we expect a thriving ecosystem to develop on the DeFi front.
And Eric, you guys are in many countries, is that correct? Like you live in Hong Kong, but I believe that you have got, many countries jurisdiction. Is that correct?
Yeah, we just celebrated our 5th year anniversary at Crypto.com, so now it's grown a bit. We have more than 2,000 employees across the globe, and a lot in Europe, in the Americas, and in Asia, of course. And we operate in more than 90 plus markets. Yeah.
That's amazing. Stefan, how many employees work for you guys?
Bittrex we have about 200 plus employees globally. That's not including sort of outsourced vendors and things. So, we're not as big.
Okay. So the question that I've got is, Stefan, talk to me about, besides crypto, what else are you guys doing?
What do you mean? What do we do? What is our business model? Well, we're a crypto exchange.
Other products. Where are you going? Like other products, you start.
So I think other than utility tokens, which is not a security, yes. We've started offering security tokens. We're one of the few that's doing that. We have a secondary license in Bermuda, and under the BMA, which is again a very hard license to get, you can trade. They don't distinguish between the tokens, so. We started offering a whole bunch of different security tokens there, like tokenized Google, Tesla, Apple. So unlike a regular security, they trade 24/7. You can buy them in small size. Definitely better for financial inclusion. But it's, I'd say it's a very relatively new product. I think the future of the markets, and again, this is centralized, but especially for security tokens, because those are securities and they're highly regulated where you're going to sell them. They fall under, just because the trade settles on the blockchain doesn't mean that it's not regulated, unlike some of our competitors don't really respect that, but not crypto.com, of course. But I think that's getting around that, and I think that securitizing traditional assets, real estate. I mean, you can pretty much do anything in a token, and it can trade 24/7. So I think that's going to be really groundbreaking and very much disintermediate the banks. Again, it's a centralized entity that's going to be disintermediating them, but I think you're going to see very big financial disruption coming forward.
I agree. Like, I work for ConsenSys, as you know, and we have a lot of clients that want to tokenize real estate, but they always ask the same question. Okay, now that we got the tokens, where do we trade them? So that's the big question. Like, for example, Nick, we always want to know, for example, if we can bring to a DeFi market and use the tokens of real estate as collateral. Like, would you guys accept random real estate tokens as collateral for your loans?
Well, yeah, so the security token market is very new. It's very liquid. Yeah. So I'd say probably not. So I think step one, you have to walk before you run. Like, you have to get things tokenized, get liquidity in the market. And that's why I think the only things you're really seeing now are what I would call unsolicited ETFs. So tokenized Google, tokenized Tesla. Yeah. That's kind of, there's liquidity existing in those stocks. And then you have utility token clients who want to start to trade that stuff, but in a tokenized digital format. So I think it's really early days. It's kind of like 2015 in the utility token market. So, I think it's going to grow really very quickly. But because it is highly regulated, and some of the less regulated players that have dabbled in it have found that has really got them caught up in regulatory, sort of scrutiny right now. So I think that people are going to tread carefully in that space.
Ajit!
Hi, Monica.
Welcome. We were missing you.
Very sorry, I'm in the middle of nowhere. Can you hear me?
Yes, where are you walking?
Yeah, forgive me, I'm on a mobile and I can't.
Sorry, guys. For the Wi-Fi and all that. Okay, let's carry on. So, Nick, would you accept a token of a real estate as collateral?
Yeah, it's definitely an interesting use case. I think Stephen was right on in that it's the early days. I think the main issues would be the liquidity of the asset. So in order to have a solvent interest rate protocol like Compound, you need a very efficient liquidation engine. If someone's collateral is falling in price and their position is at risk of falling into default, there needs to be an engine. There needs to be an engine where a liquidator can come in, seize that collateral, repay the borrowing position. And so if there isn't sort of a liquid market and it's a non-fungible asset, then it presents a whole different sort of set of risks for the overall protocol and could introduce systemic risk. So I think we'll likely see that form of collateral start out in more of an OTC managed setting. Once there's more of a mature market for those assets and they're more liquid, then absolutely it'd be great to tokenize all sorts of real world assets like real estate and have them be used as collateral to borrow against on protocols like Compound.
Yeah, agree. And Eric, are you guys thinking of going in that space for real estate tokens to be traded?
Yeah, not really at this stage. I think
Are you
there's
guys
a lot
following
to
the
be
map at
done
all?
with non-securities,
Who has the
and
map?
I think we can see the DeFi space thing last year in the famous DeFi summer. But some of the protocol like Compound and others been working on this for many years. So it really came to fruition and started a kind of a revolution there. And we saw a lot of institutions also joining retail. And that's why today I think we're having that conversation, and we're seeing also some of these protocols and companies offering services to make it easier for institutions to benefit from DeFi, and not only about better yields, but also kind of new way to invest for them and deploy their capital, diversify their risk. So it's very exciting to see that transition from retail, then going to some of the more crypto advanced institutions to more mainstream institution now trying to dabble with DeFi on non-security at this stage. Yeah.
And what about the unit trust industry, the mutual funds? As you know, in the legacy financial market, that's very antiquated. There are hidden costs, hidden risk, all that, and many layers of intermediaries. Why are you guys not going into that? Because that is such a no-brainer. You buy the stock, you create the portfolio, and then you tokenize and you sell the units from the issuer to the investor. Is this
Well, I
something
think you're seeing the other way around now. So Grayscale and companies like that are taking tokens and turning them into stocks. So it's like square peg, square hole. So you've got a lot of retail investors who are too afraid of the blockchain still, or you've got institutional investors who by their mandate are not allowed to buy that, but they want to get exposure. But if you wrap it in something and call it a stock, then they can buy it all of a sudden, and then they can get exposure.
That's true.
But I think the other way around, I don't think so. I think on the other side, again, we are seeing that happening already, but the small example would be these unsolicited ETFs. So tokenized Tesla, tokenized Apple. I guess we could certainly do it in a fund pool. I think that will happen, kind of like to Nick's point, but I think it's just early days. Like you have to walk before you run. So I think that will definitely happen the other way around. I mean, I think convergence between crypto and blockchain, it is just financial services. It's just two different settlement systems. And we're seeing a massive convergence that's just beginning right now.
Yeah. Do you know that they asked Joe Lubin what's going to happen to finance in the next 10 years, to DeFi? And he says, finance, DeFi will be called finance because nobody will realize that everything had been decentralized. Is that what you think is going to happen? That eventually we will all move to like a DeFi type environment?
Well, so again, I think there's blockchain versus old world, or crypto versus old world. I think the whole world will become on the blockchain, but I think there'll be centralized and decentralized. I don't think everything's going to just become decentralized. I think especially institutional things are going to be very regulated, and it's unclear what the regulations around DeFi are going to be. So I think you'll still have both. So I think it's crypto and blockchain are the huge disruptors, and then DeFi and CeFi are just two different ways of kind of doing it.
Operating.
But maybe the others on the panel disagree.
Other views?
I agree with that. I think the average user won't be exposed to DeFi directly. I think the great thing about these protocols is that they serve as, in Compound's case, this really baseline underlying infrastructure for yield, essentially an API for yield that anyone can plug into. And so the real opportunity for different types of fintech companies or legacy banks is to build better experiences on top of those yield. So, whether they're instituting different parameters on the duration or liquidity, making it easy to connect bank accounts, I think that's where the real opportunity is. So someone, an end user may not know that whatever offering they use to trade or to get interest is powered by DeFi in the background. But they have a familiar experience and just sort of reap the benefits without the operational complexity of worrying about private key management and custody and paying gas fees. All that is sort of managed and abstracted away from them.
Yeah, I agree. Eric, what do you think?
No, I concur as well. I think we're trying. The first step is within our DeFi wallet. We integrated Compound but it's like 2 clicks for someone. They will know it's compound, it will be mentioned, but it's just select a token, what's the yield, two taps, and they have this exposure. And as we move forward, this will move to CeFi platform, and it will be fully abstracted for users, and it will just enjoy the yield and other experiences that can be built, whether it's variable or fixed or other type of rewards that can be added to it. So definitely this is the trajectory we're seeing. And I would say the banks and the traditional players have seen this kind of investment thesis or equity story play out in other industry, the music industry, in retail. It's DeFi is it's software with that touch of decentralization, and that will eat finance as well in the traditional way progressively.
Oh yeah,
I agree.
We're all going to disintermediate Goldman Sachs. That's gonna they're out of it. And if you listen to these banks, one part of the bank is like building a crypto desk. Literally, the head of the asset management division in the same week will come out and say crypto is like rat poison. Don't touch it. I mean, it's just unbelievable.
Unbelievable
Stupidity.
Yeah, we're going bankless, guys. Woo! Okay, excellent. Now, how do we bring the institutions?
So institutions are still centralized buyers. I mean, like we see a lot of institutional clients on our exchange. They come to us because they have to have a counterparty. They can take Liechtenstein country risk where we are. So that's one thing. So a lot of these exchanges, they can't even trade with them because they're in a country that they don't have country approval for. We're regulated. So institutional clients, as they start to move into the space, they are moving towards centralized exchanges because that's by definition their rules. They have to deal with regulated counterparties, their compliance. Now, we have listed a lot of DeFi tokens just without fees because we want to give exposure. So I think, going to Eric's point, they want exposure to this totally disruptive business model, but they have, square peg, square hole. There's only certain ways they can access it. Whereas retail customers can do a DeFi play on DeFi. So I think there's more than one way to skin a cat.
Definitely. And I mean, they have also obligations. So they need to look at how they custody the funds. They need to look at what tools they have for monitoring. They need to ensure best execution as well. There's a few parameters that are added on institutions if they want to play the game. And that's why those steps needs to be managed. Some part a little bit centrally, especially for KYC. They also need to look at the pools and where the money is coming from on the AML standpoint. So there's a lot of consideration that goes into this decision. And that's why we're seeing these products emerging and the demand to have these different building blocks for institutional players to invest into the space.
And Nick, do you find that institutions get a little bit scared when you talk about a DAO?
Yeah, I think it's just a new sort of paradigm for them to wrap their heads around, particularly in sort of the risk management department. So if you take a very simple transaction on a protocol like Compound, something like supplying USDC to the liquidity pool and earning interest, the different sort of risks that come into play there would be, number one, the underlying peg risk of USDC. That'll always be redeemable for $1. The code security risk of the Compound protocol, the liquidity risk that the pool won't be 100% borrowed out and they can withdraw on demand, the default risk that the borrower's positions will always be over collateralized and there won't be any solvency concerns. So I think it's more of just an education hurdle of helping them understand how those risks are well mitigated in these decentralized systems. I think they very well understand the benefits of things like higher yield in a low interest rate environment in traditional markets. So it's really just helping them understand those different risks, how they're being mitigated, and how they can participate as a result.
So the question I've got still for you, Nick, is how do you cope with the fact that I don't think that you guys do KYC? Is that correct?
Yeah, so for Compound Treasury, we do KYC as well as accredited investor verification on any of the institutions that we onboard. The Compound protocol itself is still open and free to access. There's no change there. We view it like interacting with any sort of decentralized system. For example, if you used the Bitcoin or Ethereum blockchain, you're not sure where the Coinbase or miner reward is coming from. But so we think it's a pretty good standard there.
Yeah. And you, Stephen, you guys do KYC.
Yeah, we're a centralized exchange, and we're supervised by a European bank regulator. So we are doing MiFID II level EU bank level KYC AML on anyone.
Wow.
It doesn't matter even if you don't. Just to get an account, you have to go through that.
Really, wow. And Eric, what happens in your various jurisdictions?
Yeah, so we also are licensed in Europe. We're actually the first to get licensed on the crypto front, virtual VFA license in Malta from the MFSA, and we also have an EMI there. So we have also strict requirement on the KYC front, and also we work with Visa. We're a global alliance partner with them. That also level up the level of requirements. So globally, we do a KYC from the onset, pretty strict. We've done that since the beginning. On all our kind of CeFi products. We have also a DeFi wallet, and this one is accessible for anyone. It's open. You have your full control. You're in charge. It's your keys and your crypto, and you can access also directly Compound as a retail user. And this one is more open. Yeah.
Fantastic. And then what's happening with self-sovereign identity, and how is that going to affect you guys? The evolution of verifiable credentials. Would that be a plus, a negative, not relevant?
What's a plus? I'm sure Crypto.com does as well. We have a lot of retail clients. The volume of clients is huge. I think we probably, in Liechtenstein, it's mostly been ultra high net worth. We've come there as a fintech company. We probably have more clients than anybody else there, just because of the nature of the business. But to do that and to do the level of KYC that they require, you have to use digital tools. So the more that we have digitization of IDs, it just makes that process much easier and user-friendly for us.
Okay, yeah. Is that how you feel, Eric, too?
Yeah, I think for us, this KYC is a requirement, but it's also a big friction in our user journey. So anything that can help us facilitate that and make it more seamless for customers, so they can get to what they come from, to get exposure to this new token that is out there, try a borrowing or lending product, get some reward on a card. I think we want to bring them as fast as possible while staying regulated. So that definitely helps.
Yeah, I agree. And then the last question, because we're running out of time. Talk to me, Nick, about your governance tokens. I love that. I really, why I love it? Because it's like so democratic and it's so inclusive, and then people have a voice and they can get rewarded by this. Just talk to me about that. I just love them. Yeah.
Yeah, absolutely. So Compound has a decentralized governance system, originally through what was called the Governor Alpha contract, which I believe now is the most used governance system in DeFi. By teams like Uniswap or Ample4, Pool Together. A number of different firms have used that in their protocols as well. But it allows anyone with a threshold number of the comp token to propose upgrades to the protocol itself. These proposals aren't instructions for another team to build something. They're actually submitting executable pieces of code that the community can vote to merge into the protocol's code base. So as you described, it really democratizes access and pulls brain share from all over the world, brilliant developers who are looking to shape the protocol in some way, improve it. There's been, I think, roughly 55 different governance proposals to tweak risk parameters, add new markets, completely change the governance system itself. So it really just ensures that the protocol will outlive its original creators. As long as there's interested developers and Ethereum is still running, Compound will be continuously upgraded through this sort of everlasting governance system.
Wonderful. And can I ask the last question? We'll go around. I want to hear from each and every one of you. What do you think is going to happen to the work that you are doing in the next 5 years? Where are we going? Like, put yourself, let's say, in 5 years' time, what's happening in your life? Okay, Eric, you start.
Well, we'll probably all live in a metaverse and we'll be surrounded by NFTs, and I think that will be quite magical. So I'm looking forward to that. We're also investing as a business in those long-term bets. We're not the only one. Facebook and others are on it. but we do feel the power of blockchain connected with those new words. It's going to be extremely powerful. We see it in gaming. We see it in the NFT space. But there's so much more that will happen. So we'll probably be all on the metaverse in our 5-year reunion from this conference.
I love that. Do you know that ConsenSys has offices in the metaverse in Decentralised? We've got the whole building. We have meetings. It's really cool.
It's already happening.
Yeah. And Nick, what do you think is going to happen? 5 years.
Yeah, I think there's a couple things that excite me. I think these sort of silos between different chains will be brought down. So whether potentially even central bank digital currencies interacting with public ledgers, it will feel more just seamless, especially for end users. Different types of assets, being able to lend, borrow, trade, everything across the board, and then just a more seamless, experience with interacting with traditional products. So I think, DeFi is essentially like a partner bank in your pocket that all these firms can tap into. And I think all these users will benefit. They won't necessarily know it's DeFi, but they know that the services they're getting are 10x better.
Yeah, I love that. Awesome. Steven, what do you think?
Well, I think in 5 years we'll know if Bitcoin versus the central banks, who's going to win. My bet's on Bitcoin. But, the central banks aren't going to go quietly. So I think we'll sort of know the outcome of that. I hope we can get some sleep in the next 5 years. I'm keeping up this crypto pace. But I think for us, I think we're just going to see more and more convergence, and there will be an active security token market globally. So all the stuff we talked about, and it'll be interesting to see how much that's eclipsed traditional securities markets, or if they still exist. And we're looking at other regulated financial services industries where we can integrate crypto. I think insurance is ripe for this.
Insurance.
Gaming, which is, we're focusing on very licensed industries where we know that our unlicensed competitors can't really enter or compete. So I think that's kind of, again, I just echo everything that everyone has said. And I think the traditional financial services players won't necessarily be the big names in 5 years.
I agree. Excellent. We ran out of time. Thank you, everybody. Lovely to have you and lovely to meet you.
Likewise.
Exactly.
Pleasure.
Thank you, guys.
Bye-bye.
Ciao. We ran out of time. Thank you, everybody. Lovely to have you and lovely to meet you.
Likewise.
Exactly.
Pleasure.
Thank you, guys.